Hello friends, in this section, we will see how we can perform backtesting using historical data. Backtesting is of critical importance for a trader because you want to ensure that your strategy would have performed well in the past before deploying it on the platform. So in backtesting, what we are doing is that we are testing the strategy by applying the rules and trading signal criteria on historical data, mimicking the actual trading condition. Mimicking actual trading condition being the key phrase, right? You want to ensure that you're not being too aggressive with your assumptions, and you have to ensure that you are trying to mimic the real world conditions as much as possible, okay? Ideally, you should factor in things like slippage, trading cost, brokerage cost, etc., because they actually eat in a lot to a strategy's performance. And this is the problem that you will see with most of the backtesting platforms or most of the research work that is available. Most research work on trading strategies do not really factor in trading cost and slippage. So the result is a bit overstated. Always try to be conservative or on the side of caution. So for example, if you are going to implement a strategy where you will place a trade only after a period is over, do not take the close price of the previous period as the trade entry point, because there's very less likelihood that you'll be able to get the fill at the same time that the last period ends. Okay, so things like that. You'll have to be conservative. Okay. Again, it cannot be overemphasized. You should not deploy a strategy until you have performed some level of backtesting, right? You don't have to perform very sophisticated backtesting if you want to kind of deploy something. If you have an amazing idea and you want to get to the market as soon as possible, but do perform some level of backtesting and make sure that prima facie the strategy has some merit. Okay. The biggest criticism of backtesting is that because it's based on historical data, you can't really say that it will perform similarly in future, right? And that's a fair criticism. But despite this criticism, backtesting is used widely in the industry, okay? So this was a brief background of backtesting, and that's what we are going to cover in this section. In the next couple of lecture videos, we will discuss some important KPIs that you need to consider to perform backtesting. Hello, friends. So now that we have sufficient background about backtesting strategies, we'll now discuss how do we get to a strategy. Do we develop it ourselves or do we borrow it from internet? How do we get a strategy to backtest? Well, for Forex trading, this is not really a big problem. And that's because Forex trading has a thriving community of traders who like to share things like their strategies, experiences, etc. And you will see a lot of forums, websites, blogs, even YouTube videos where established Forex traders share their strategy. I mean, they won't give you everything, but they will help you understand what is the intuition behind what they're trying to do. And in this section of the course, I will take you to a few blogs where traders have explained some of the established strategy and will try to backtest them as well. But in this lecture video, I want to spend some time discussing how a new trader may develop his or her own strategy. How do you develop that intuition of what might work and what might not work? So that's what we'll try to do in this lecture video. So this is one of the charts that I have in front of me. This is the Euro USD hourly chart. I don't like the candlesticks right now, so let me change this to close price chart. And this chart is not really giving me everything. Sorry, let me switch off this auto scrolling option that MT5 has, so that whenever a new tick comes, it doesn't take me to the end of the chart because we have to go back in time. All right. So again, if I go back in time, there have been phases where the price saw an uptrend, then a downtrend. But looking at just the price, it is not really telling me much what could be a leading indicator or a signal. I mean, there is some volume data here, but with Forex, we typically don't use the volume information because it's a decentralized market and we don't know where the broker is getting this volume information for. We can never be sure about the volume information in any decentralized market, so I don't want to give much heed to this volume information. So right now we only have this closing price, which is not really helping me. So I can't really develop any strategy out of it. So why don't we insert an indicator? Let's go with a popular one. So let's use an MACD oscillator. Let's go with the default parameters 12, 26, and 9. We have already discussed MACD in the technical indicator sections. So hopefully you have fairly good understanding about this. So click on OK. And this is my MACD indicator. So these bars that you see, these are the MACD values. And this red line that you see, that is the signal. All right. So we've got both MACD and the signal. Okay. So this might help me in a way that I can come up with some kind of a signal that tells me when the price is going to go up or down. And sorry, I'll keep using the term price. So whenever I use a term price, just know that I'm talking about the exchange rate. But there is no concept of price in Forex trading. But because we come from equity trading background, these slip of tongues are allowed for us. All right. Fine. So this is the Forex rate and I want to know when is it going to go up or down. All right. So let's try to develop some intuition. Can you look at these charts and see whether you can predict whether the price went up or down based on this MACD? So it looks like, just from a very limited sample that I'm analyzing, it looks like whenever the positive wave turns to a negative wave of MACD, the price starts to go down. So here the MACD turned from positive to negative. From strongly positive, you can see that it became strongly negative. And somewhere here, if I considered this as a signal, 2 consecutive negative MACD values after a string of positive values, it looks like from here, it was not a bad signal. The rate actually started to go down. If we close out a position here, then we would have made how many pips of profit? So here the close price was 1.0915. So 915 and here 865. So almost 50 pips profit. So if we went short here and close out the position here, we would have made 50 pips in only a few hours. I think this is 10 or 12 hours. So that's not bad at all, right? But you can see that it then again went up. When the MACD turned positive here, we pretty much wiped out all the profit that we made. Let us try to see some other instance where the reversal took place. This is all positive. Where did it turn positive? Let's see. Okay, here. So after a string of negatives, here it started to become positive. So if we enter here, this would have been a really good signal because you see that there was a string of positives. And the first time it got negative after this positive wave was somewhere here. You can see that the value is minus 0.00041. So we would have exited here. So this would have been a really nice trade, right? We would have made how much? So we would have entered somewhere here. So close price 1.06843, and here 1.0841. So almost 160, 170 pips. So that's pretty neat. So it looks like this strategy, if you want to call it a strategy, has some merit. Here also from a string of negatives, we got a positive here. So we would have entered here. No, this was not a good trade because soon after it became positive, it again became negative and there was some volatility. But no, this was not a good signal. But it looks like a lot of them are good signals. So here, after positive, it turned negative. So if we would have entered here, looks like we would have made some money. All right. So, okay. So this looks like a signal that we can work with. So the intuition is that if the MACD values turns negative after a string of positives, that is a signal for me to go short. And if the MACD values turns positive after a string of negatives, then that's a signal for me to go long. So that's as simple as that. Now, the problem is, how do we exit? So signal is great. We know when to enter a trade. The biggest challenge that you're going to face, especially as a new trader, is to come up with a decent exit strategy. So usually the strategies that we'll discuss, they do provide good quality signals. So when you get a signal, there is a high probability that the market would move in the direction that you intended it to move. But when do we exit? So we saw an example wherein the signal was great and we made 50 basis points. But if we continued on that trade, we would have lost all our profit. And therefore, coming up with an exit strategy is almost as critical, I would say more critical, than entering a trade. Let me clarify that in this course, you are not going to get the gospel truth about exit strategies. Exit strategies are hard, and for different traders, different things work. But what I'll do is that I'll give you some intuition that you can use when you are devising your exit strategies. You can use things like support and resistance levels. You can use things like trailing stop losses. Although in MT5, I have not seen a trailing stop loss features, but we can use the API to come up with some kind of a quasi trailing stop loss as well by keep revising the stop loss figure using the API. So that can be done. But for this intuition that we are trying to develop, let us use support and resistance. So for example, this signal that we talked about, so we would have entered somewhere here when from positive it became negative. So we would have gone short here. Now, I need to come up with the support and resistance. So we will stay in this trade until the exchange rate reaches its support level, which I would assume would be somewhere here. So let us go back in time and see what was the support at this point of time. So again, we have discussed when we were discussing support and resistance is that when you are trading on a given time frame, you go one time frame up to identify the support and resistance. So here we should go with H4. My only concern is if I do that, I will lose track of the time frame. So 29th November 5 p.m. is when we got this signal. So let me go H4 and 29th November 5 p.m. somewhere here, we have to go back and try to find what would have been the resistance level. So in the short term, I would say that this would be a decent support level. Although if you go longer frame, some traders would consider this as a support level, but this is fine for me. This valley is fine for me as the resistance because A, this was more decent. And if you go back, you can see that in the same neighborhood, there have been a couple of rebounds. So here, so we are talking the same ballpark. Or you can have the resistance somewhere here in between these three valleys. All right. So, this would have been a nice take profit point for that trade. So 29th November 5 p.m. I would go with the support price of 1.0878. All right. So let's go back to H1. Let us go back to 29th November 5 p.m. All right. So this was the point that we wanted. So we would have entered a short position at 1.09683, which was almost 100 pips above the support price that we just saw. So in this case, we would have got 100 pips profit because this trade went all the way down till 1.08377. So lower than our support price, which would have been the take profit for our trade at that point of time. So this was good. What about the stop loss? So in this case, resistance. What would be the resistance price? Once again, let's go to H4, 29th November. So we are somewhere here. So this looks like the support price. This occurred actually quite recently. But if we go back, this has been the support price. So it looks like this currency pair is on I think a few day high. This is the high price. As of 29th November 5 p.m., it started to come down from a fairly high rate. So this would have been my resistance level or stop loss level. And you see that if you entered this trade, you would first meet your target before meeting your stop loss. So had this trade went up like this and then went down like this, then you would have made the loss. But in this case, it kept on going down and our short position kept on becoming more profitable until we reached the take profit level. All right. So this was a crude example of how new traders can look at the charts, analyze the data and come up with a strategy. So I would not call this a strategy, but again, an intuition that we will backtest. So what I'm going to do is that I am going to take the historical price for a given exchange rate. I will analyze their MACD values and then I'll write a strategy wherein we would see when the MACD turned from positive to negative and negative to positive, and I will use that as a signal. For exit strategy, I will use the same find support and resistance function that we have discussed earlier. I will identify the support and resistance at any point that we got a signal, and we'll use that as the take profit and the stop loss price. So this is my strategy. Let us see if we traded using this strategy in the past, how would we have performed? So let's do that. Hello friends. So now that we have a workable intuition, let us backtest that and see whether it has the potential to be called a strategy or not. So the way I want to structure this backtesting is that we will use the functions that we have developed in the previous lecture videos, for example, getting pips, getting support and resistance, etc. So all that you'll have to do is import those functions that we have previously developed and use them. So what I have done is that I have created two Python scripts. One is called utility functions and one is called technical indicators. So in the first script, which is called the utility functions, I have pretty much copy-pasted the functions that we have previously discussed. These are key functions that will help you get information. For example, getting the pip value, getting current price, getting historical data, getting support prices, resistance prices, right? These are important because, as you may have figured out, we would need this information to implement backtesting. Just make sure that you store these Python scripts in the same folder where you will keep your actual backtesting script that we are going to develop. Just one thing to be mindful of here is that, for example, this function, get current price. If you recall, when we discussed this function in one of the previous lecture videos, it would have looked something like this. I would not have this MT5 as an argument to this function. And why was that? And that was because we are already importing MT5 and creating an instance of the MetaTrader 5 object, and we also authenticate it. So this MT5, when you use this within this function, it is already the authenticated MetaTrader 5 object. But when I take this function out of this Python script where I am importing and authenticating MT5, I will have to pass this as an argument. So what will happen is that I will import this get current price function from the utility functions. All right. So this Python script will go to utility function script and it will run this particular function. But if I don't have MT5 here, it's a problem because I am not importing MT5 here and I'm not authenticating MT5 here. So if I remove MT5 as an argument, this doesn't make any sense. All right. So you will have to pass the MT5 object as an argument to this function. So anytime we have used one of the MT5 API functions in any of the functions that we have developed in the previous lecture videos, and if we are using them, then we will have to just make this change and pass MT5 as an argument. So that's the only change that you'll have to be mindful of. Alright, this is basic Python. If you have worked with multiple Python scripts, you would know what I'm talking about. Alright, so just be mindful of that. So I'm going to share technical indicators and utility function scripts as well in the resources section. So don't worry about that. But that is how I'm going to structure this backtest. I'm going to import all the functions that I need. And in this backtesting code, we are only going to have the backtesting. Another thing that you will see here is that instead of key.txt, I'm using key_darbinex.txt. And that's because you will see that the actual data that brokers give you and the MT5 demo data that we have been using, it could be different for a number of currencies. So whenever you are backtesting, backtest only on the broker in which you're going to trade. So in this case, I'm going to use Darbinex. And the only change that we'll have to make is just change the file name where the Darbinex login credentials are stored. Alright, so that's all great. Now let us start implementing our backtesting. First of all, let me pause for a few seconds after initializing the connection because sometimes there may be a lag. And let me import time here as well. Right, one more important thing is that this utility function and technical indicators, wherever you have stored these scripts, you will have to use the change directory function of the OS package and mention where you have stored these Python scripts. Otherwise, your system would not know what is utility function and what is technical indicators. All right. So make sure that you give this path. So let me give this path where I have stored these scripts. All right. So that's taken care of. And I'll be importing a lot more functions than just get current price. So this line will change and I'll also have something from technical indicators. All right. We'll have to import MSCD. So with that taken care of, what are the global variables that we will need? First of all, symbol, for which symbol we want to backtest. Since we were discussing Euro USD, let me use Euro USD. Then another variable that we'll have to use is the backtesting window. Do you want to backtest on 1 hour data, 4 hour data, 1 day data, right? So let me call it backtesting time frame, and that would be required to get the historical data. And if you remember, in MetaTrader, this is how we define the candle, what candle we want, 4 hour candles, 1 hour candle, whatever. So let us go with 1 hour candle, time frame H1. And then we will also need the time frame for support and resistance. If you recall, we are going to use support and resistance as the exit strategy. So we would need that as well. And like we have discussed, this is typically a higher time frame than what you are trading on. So let us make this H4. And again, we'll tweak these time frames to see for which backtesting time frame and support resistance time frame we are getting good results. But right now, these 3 global variables are the one that we want to test. Now, let us get the candle data. Because we are backtesting on hourly data, I want hourly data going back whatever backtesting period you want to test on. So to get historical data, all that we'll have to do is use historical data here. So import get hist data. So get hist data, and what are all the parameters that I need? MT5 symbol time frame till time. So let me copy this whole thing and paste it here. So MT5 we already have, symbol we already have. This time frame would be the backtesting time frame. And these are default. If we have time till is equal to none, then we'll get data till the latest candles. And then number of candles I'll have to increase. Let us go with 10,000 candles. All right. Since we are going with 1 hour candles, so we will have 24 times 5, 120 candles in a week. So this would be how many weeks? Almost 80 weeks, which is close to like, 1.5 year worth of data. So that's fine. So we are backtesting over this period. So as we are progressing, let me also run these pieces of code so that if we have any error, we would know. So let me first run this and see if we have any problem. Yeah, no module name utility functions. What happened? Oops, I have a typo in the actual function name. So let me fix that. That's pretty embarrassing. Give me 1 second. Okay, so I fixed the spelling now. So now if I run this, we have got the data. So if I go to Variable Explorer and access candle data, you can see that we have got 10,000 rows and 7 columns. We have got open, high, low, close, tick, volume, spread, and real volume. And we've got data from April 2022 all the way till the current date, which is December 2023. All right. Now I need the MACD column, right? So let's do that. So for that, I'll have to import MACD from technical indicators. So let me do that as well. From technical indicators, import MACD. And once again, I'll have to change the directory and then import this. Okay, and how have we defined this function? All that we'll have to do is pass the data frame or the candle data that we have, and it will give data like this. All right, so that should be fairly straightforward. So candle data, let me copy this, the columns that it outputs is equal to MACD candle data. All right. So if I run this line of code, I should be able to get these additional columns in the candle data frame that we just saw. Right. And you can see that we have got 10 columns here. So if I open this, we have got the MACD signal and histogram information. So now all that we'll have to do is go row by row, check whether we got signal or not for a given candle. And if we got a signal, then we have to store that price, that trade entry price, and then see when we would exit. So we would store the entry price, and then we would see for each candle whether the take profit or stop loss happened or not. And if that happened, we would store the trade exit point. So that's pretty much it. If you have the trade entry price and the trade exit price for all the trades, we've got all the information that we need to implement our backtesting. So that is what we'll have to do. But this is easier said than done. It would need a lot of care and a lot of thought to get all the data that we need, keeping in mind everything that we discussed about good backtesting practices, that is being conservative, not being overly aggressive, being mindful of all the things that can go wrong, etc., etc. Okay, so what's the first thing that we need? We would need the signal. So let us initiate the signal variable as none. Then we would also create a column called returns in candle data. And we'll need that because when we are discussing the various backtesting diagnostics, we would need the return values. So the idea is that in any candle, if we are having an open position, then we would calculate the return. So for that particular candle, if we had an open position, what was the return that we got? All right, so that is what we'll get. So let me create this column right now and let me initiate this column with a 0 value. Then we would have a variable called trade stats, and this is going to be the most important variable that we'll have to populate. So trade stats would have open price, close price for every single trade. We can have other information as well. For example, for that trade, what was the stop loss price, take profit price, etc. So that it's easier for us to see whether a given trade was stop lost or whether we achieved our profit target. So we will update all those information here. So the idea is that this list would have a number of dictionaries and each dictionary would have trade stats. So for example, what was the time in which we took a particular trade? What was the entry price at which we entered a trade? And things like that, right? So each dictionary would have a number of trade parameters, and we will store this information to process it later and see how our strategy performed. All right. So right now, let me have this as a blank. And another thing that I like to do before delving into the actual backtesting is that I want to identify the columns in this backtesting data frame. So we have open, high, low, close, blah, blah, blah. So we can either use the column names like open, high, low, close, or we can use their index 0, 1, 2, 3, 4. I like to use the column index numbers. So let me do that. So MACD index is equal to candle data dot columns. If I'll run this, I'll get all the columns that we have. I'll convert this to a list. So now the same thing that you're seeing here will be in a list, which is much easier to work with. And then here, I will find the index for the column MACD, right? So this would be 0, 1, 2, 3, 4, 5, 6, 7, right? So this should give me the index 7, all right? So you can actually count it, right? So you can open the data frame, see 0, 1, 2, 3, 4, 5, 6, 7, or you can use this command to get the index pertaining to MACD. And I prefer this because, you may change the code, you may add a few columns when you're backtesting. So it's always good to get the numeric index for a given column programmatically. So likewise, I will also find the index for open price, close price, high price, low price, etc. because I'm going to use that in my backtesting. So let me do that as well. All right. So just like MACD index, I have got the index for the open price, close price, high price, and low price. Now let us begin our actual backtesting, which is iterating through the candle data frame and then performing our analysis. So for I in range, length of the candle data. So length of candle data is 10,000. So this would go from 0 all the way till 9999. So when we are iterating through every single row, the first thing that we have to check is whether we have an existing signal or not. So if signal is equal to none, that means if we don't have a signal, check whether we've got a new signal or not. And how do we do that? For a long signal, we discussed that the two consecutive MACD values should be positive after a string of negatives. Alright, so that's very easy to encode. Candle data.iloc. So with iloc, you need to give the numeric indices of rows and columns that you are interested in. So the row would be I because we are iterating through that particular row. And then the column would be MACD index. So if this value is greater than 0, likewise, if the previous value is also greater than 0, that means we have got 2 consecutive positive MACD values. But this is not all. In conjunction with this, the previous few candles have to be negative. So we'll have to use another and let me copy this thing here, paste it here. And how will this thing change? Obviously, I'm not going to do it for 6 values and. So we'll have to get a bit smart here. So let us check from I minus 8 till I minus 1. So what will this do? This will check from the 8th last MACD value till the 2nd last value. So I hope you know how Python indexing works. So this is from I minus 8 all the way till I minus 1, not including I minus 1. So because I minus 1 is already used here to check whether it's positive or not, we have to check till I minus 2. But if I do I minus 2 here, then Python will not include this. So I'll have to use I minus 1 if I want to test till I minus 2. So essentially what we are doing is that we are checking for 7 previous candles. So we check the current candle, whether it is positive or not. We check the previous candle, whether it's positive or not. And then we check the previous 7 candles to check if any of them were negative. So how would we check if any of these were negative? We would check the whole thing, whether it is less than 0, and then use the any operator of pandas, right? So this would be true if any of the values in this range were negative. Alright, so if this statement is true, then we'll make the signal as long. Hey, hold on. This should be all. Sorry. If any of these values is negative, then we'll get a true. I actually want all. Every single one of them should be negative. Sorry about that. Yeah. And why is this giving me an error? So there's something wrong here. I have not used if here. Sorry. Alright, so you can see that, we have to go back 8 rows to ensure that we get the first signal. So when you're starting out this particular loop, you start from the first row. So when you are in the first row, there is no concept of going back 8 rows. So you will have to make some changes here. So this will have to start from 8 so that I minus 8 is 0. So this range, the first value will have to be 8. So that's one change that we'll have to make here. Now, once we have identified that we'll go long, we will calculate the support and resistance at that candle. So for that candle, what was the support and resistance? So for that, we'll have to come up with a function, which we'll do later. But let us say that it will be called find support resistance. And then we'll provide some values. So let me create a placeholder for that function. Define find support resistance. Let us just create a placeholder. So when I'll create this function, I will return support and resistance as a list. So let me have this like this here. We can return these values as a tuple as well, but I like to store things in a list, so I'll do that. But this is for later. Right now, let us continue. Now, as soon as we get a long signal, that means we will enter a trade. So when we'll enter a trade, we will have to update this trade stats variable. So trade stats dot append. What all do you want to store for the trade? Let's store as much information as you want. First would be the time. So the time would be whatever is the time index for that particular row. So for example, let's say we got a signal, a long signal for this particular row. Then we'll store this index within time. Alright, so this is when we entered the trade. I mean, this is not the time when we exactly entered the trade, but this is the beginning of the candle when we got the signals. So this would be simply the index. So candle data dot index, whatever is I. Now, what else do you want to store? Let us store the direction as well. For each trade, we want to know whether we went long or short. So let us store the direction. Then the important point, open price. Now, what do you think would be the open price? Think about it. Let's say we got the signal here. Okay, so we analyzed the MACD and all and we identify that here we would have got a long signal. What do you think would be your open price? So obviously, by the time that we get a signal, this candle is complete. So you are not going to get the close price of this candle. So we are already in this candle when we want to place a trade. So you can use the open price, but that would be too aggressive. Typically, there's a concept of slippage, and therefore you will get a price somewhere between the open price and the high price for the next candle. And that is called slippage. So we'll have to factor slippage in our backtesting. So let's do that. We will take the open price of the next candle, the high price of the next candle, and take a value somewhere in between them. So the open price would be candle data.ilog. Again, be careful here. You'll have to use I plus 1. Not the same row, but the next row. And the opening price index. So OP index, which we have calculated here. Alright, so this will give you the open price of the next candle, but we are not happy with this. We want to factor in the slippage as well. So I leave that to you, what factor you want to use, but I want to be a bit conservative. So I'll take the open price plus 30% of the difference between the high price and the open price. Alright, so again, some people may say that I'm being a bit too conservative, but that's fine. It's good to be conservative. This would be the high index, so HI index minus the open index. Alright, so this would give us an open price including slippage. What else do we need? We need the close price. So close price at this point is none because we have just opened this trade, so there is no concept of close price at this point of time. Let's also store the SL price and the take profit price. So SL price would be what? Support or resistance. Think about it. It's a long trade. So the support price would be the stop loss price. Support is lower, resistance is upper. So this would be support. And lastly, the take profit price would be the resistance. So this would flip if we have a short signal. In short signal, resistance becomes your stop loss price and support becomes your take profit price. But for long, this is a dynamic. Alright, so we have now stored all the information that we need when we initiate a position. Okay, one corner case to keep in mind is when your open price is less than your stop loss price. So because we are factoring in slippage, it is possible that your open price ends up being less than the stop loss price. So what would you do in that case? Again, you can do a number of things, but for the purposes of this code, if that corner case or edge case happens, we'll simply use a stop loss and take profit levels as a fixed level. So for example, 80 pips or 50 pips or whatever. Okay, so let's do that. So if trade stats, the last value, so the value that we have just updated, if the open price is less than the stop loss price. So let me copy this, paste it here, and change this to SL price. If that's the case, then I will assign the stop loss value as the open price minus 80 pips. Alright, so minus 80 into, we have the function get pip. If I recall, we have created it somewhere in the utilities. Yeah, get pip. So let me import get pip here as well. And we'll have to pass for get pip MT5 and symbol. So let's do that. Likewise, if the open price is greater than take profit level, then we would have to add 80 pips to the open price. Alright, so TP price. Let me make this less than equal to greater than equal to. This would be TP price plus 80 pips. Alright, so this is all that we have to do if we identify the signal as long. Let me copy this entire code block and paste it here. Let me fix the indentation and let's do the same thing for short. So in this case, if we get two consecutive negatives and this becomes greater than 0. If the previous values are positive and the current values are negative, then we get a short signal. This is fine. Nothing changes here. Direction would be short. Open price would be the open price of the next candle minus open price minus low index, right? So that would change here. So this would become open index minus the low index. All right, the dynamic reverses when you are going short. Close price would be none. SL price would be a resistance and TP price would be support. Now with short, again, the open price, stop loss price dynamic flips. So if the open price is greater than equal to the stop loss price, the stop loss price would be open price plus 80 pips. Here again, it would be flipped. Less than the take profit price, this would be minus. Alright, so this part of the code takes care of what happens if we do not have a signal. As we are iterating through the backtesting data, if there is no signal, this is the logic that we will use to identify whether a new signal has been generated or not. And if it is generated, this is all the information that we will store. I'll stop this lecture video now because this has become a bit lengthy. In the next lecture video, we'll continue this and see what happens if there is an existing signal, what steps we'll have to perform. So I'll see you in the next lecture video. Thanks. Hello friends, continuing from where we left off, we will now see what happens when there is an existing signal, long or short. Okay, so we'll have to have another code block. Elif signal is not null. So let's go with signal is equal to long. So the first thing that we'll have to check if the signal is long is whether for a given row, the stop loss was triggered or not. And how do we check that? We already have stored stop loss in the trade stats variable. So if trade stats -1 stop loss price, meaning the stop loss price of the recent trade or the last trade, which is the ongoing trade right now or the ongoing position, if the stop loss price is less than equal to the low price, think about it. If you are going through each of the row, let's say your signal is long and then you're trading, and you reach here, right? And let's say your stop loss price was 1.07334. But for this row, that stop loss price was breached. The low price was 1.07332. So that means here the position would be closed out and we'll have to cut our losses. Alright, so that's exactly what we are doing here. If the stop loss price is actually greater than, or if the low price is less than, right? So if the stop loss price is greater than equal to candle data low index, alright? So if that's the case, first of all, we'll have to change the signal to none because we have now closed the position and there is no signal. Okay, why am I getting undefined single? I keep making these typos, sorry. Then you'd have to update the closing price in trade stats. So trade stats, close price. Again, any guesses for the close price? What would it be? It would be the stop loss price because the stop loss got triggered. Okay, so this is very easy. So we'll update the close price as the stop loss price. Ideally, you should also use slippage here, but I'll let you update this and include slippage. But anytime we are entering a trade, you will have to factor in the slippage. So just like we factored slippage when we were opening a position, you will have to factor in slippage as well when we are closing the position. And if we already have a signal, that means for that row, we will have to have some return. Okay, now think about it. So if we have an existing position, that means we would generate some return for this particular candle. If we do not rule out the position, then the return for this particular candle was simply close minus open. But if you closed out before this candle got completed, then your return would be whatever is the close price during that candle minus the open price. Okay, so that's what we'll have to do. So where are we storing this return? We are storing this return in the column called return. And this is the last column because after this we have not created any columns. So you can access this return column in a number of ways. You can use candle data dot lock I return, or you can use ilock, and instead of return you can use -1, which refers to the last column. Okay, I'll leave that to you what you want to use. Now what would be the return in this case? So think about it. For this particular candle, the closing price was the stop loss price and the opening price was the opening price of the candle. So let us use the close price, which is same as the stop loss price. So close price minus the open price of this particular candle. So candle data open index, alright? But this will give us the values in decimals. We don't want that. We want to talk in terms of pip. So that is easy to convert. You just take whatever difference you get and you divide by the pip value for that particular symbol. Just use the getPip function and divide this difference by getPip. So we've got the return. Now let me copy this code block. Let us paste it and now update this logic to see what would happen if we hit the take profit target. So in this case, if TP price is less than or equal to the high index. So what does this mean? This means that the high price for a given candle breached the take profit price. So if that happens, that means you will close out the position and you will take your gains. So if that happens, signal is equal to none. The close price would be the take profit price. And again, in this case, we won't have to change the return. It would be close price minus the open price divided by the pip. And let's make this elif. One more condition I want to put in if the signal is already long or short. Let me take you back to the chart. So rather than waiting for the support or resistance to get triggered, I would want another exit strategy, and that is in case of false signal. So for example, in this case, here we would have got a long signal and you would have gone for it. However, you see that soon it became negative. So if we are long and the MACD value turns negative, that would also that this signal may be a poor signal or a false signal. So if that happens, we will also exit. Okay, so I want to include that in our code as well. And actually, I'll not just do it for one MACD value turning negative, because one can be coincidence. But if two consecutive values are negative, then we will exit our long position. So we'll have to check the last two MACD values, and we've already done something like that. So let me copy this command here and put it here. So elif. So we'll check the last two values, last two MACD values. So check from row I-2 till the current row. It's actually three MACD values that we are checking here, I-2, I-1, and I. If you want to check just two, you can make it I-1. Let's go with I-2 and check three MACD values. If any of the past three MACD values is negative, once again, close out the position. So signal would be none. The close price in this case would be a bit tricky. So think about it. Let's say here we find out that the third MACD value is negative for a long signal. So what you'll do is that in the next candle, you will close out. So whatever is the open price plus some slippage would be the close price. All right. So it would be the candle data ILOC I plus 1 open price index. Are we using OP index? Yes, OP index. All right. And once again, I'll leave for you to include slippage. For closing positions, we should also have slippage, but I want you to do that. And the return for this candle would be simply the closing price minus the opening price, because we'll close out only after the entire candle is completed. So we'll have to use the close price here again. You can use the close price of the position, assuming that the closing price of the candle and the closing price of the trade are fairly close, because it's just a slippage that you'll be off with. But let's try to be accurate here. So this would be the closing price index for that particular row, I, and then this would also be I. Okay, why do I have I plus 1 in all these places? Is that because I simply copied from here? Yeah, sorry. These would all be I, because when we are calculating return for a given candle, we concern ourselves with the open price of that particular candle and not the next candle, right? So sorry about that. So I'll be uploading these codes. So make sure that you go through these code logics and ensure that you understand them well. If you don't understand them, please post it in the Q&A section, because it's very important for you to have a very thorough understanding of how these calculations are being done and whether you understand the underlying logic or not. Alright, so this is pretty much all that we'll have to do. Just one more thing. If the signal is long and none of these things happen, meaning that the trade doesn't have to be closed, then we simply calculate the return for that particular row, which would be the same thing as the previous code block. Alright, so that takes care of what happens when we have an existing long position. Let me copy this and then let me paste this code block here and then try to tweak these logics for if signal is short. If the stop loss price is less than equal to the high index, close price would be same as the stop loss price, so this line doesn't have to be changed. Here we'll have to flip it, so the open price minus the close price, right? Let's say your open price is 100 and then you close it at 80. So your return is 100 minus 80 or 20. But if the return goes to 120, the return is 100 minus 120 or minus 20. So when you're short, you always take the close price and subtract it from the open price, which is opposite to what happens when we are long. Alright. So for the second code block, if the take profit price is greater than equal to the low index, signal is none, fine. This would not change. Close price would be the take profit price. Once again, we'll have to flip it. So you can simply put minus here, but it's okay if we want to make it more intuitive. Okay, here what we'll have to do. So if the previous 3 MACD values are greater than 0, that would tell us that the short signal no longer exists and that we need to get out of this position. So once again, we'll have to convert signal as none. The close price would not change. And once again, we'll have to flip this, open minus close. Likewise, if we have to continue the short position and there was no need to close out of the position, then we simply calculate the return as opening price minus the close price. So this is pretty much the entire backtest. Just one thing that I would add to this particular code is what happens when we reach at the end of this particular data. So we have these trade stats wherein we have open price, close price, whatever. So if there is an open position and we reach the end of the road, let us simply update the close price as the close price of the last candle. We don't want to have none price for close, otherwise you might get an error. So if the close price of the last trade is equal to none, which means that we have reached the end of the backtesting data and one of the open position doesn't have a close price, we'll simply update it with the last closing price. Candle data, I lock, close price index. What would be I in this case? -1, the last row. Alright, so this takes care of our entire backtesting algorithm. This is it. All that we are doing is that we are going row by row. We are identifying whether a signal would have generated or not back in time. If the signal would have generated, we would store the relevant values, open price, close price, stop loss price, take profit price, etc. And we do that for the entire backtesting data. So if you recall, the only thing that we need to update for this code to run is to get the support and resistance value. So let us do that in the next lecture video, and then we are all set to perform the diagnostic tests. So I'll see you in the next lecture video. Thanks. Hello friends. So the last piece of the puzzle is updating this find support resistance function. And the idea is that as soon as we pass the symbol, this function should give us the support and resistance values. And you may say that, hey, we have already developed, get support and get resistance functions previously. So what's new that we are doing here? Essentially, what we are doing is that rather than having these functions separately, we are combining these functions into one. And this would be a more streamlined way of getting both support and resistance using just one function call. So first of all, we'll have to import get support and get resistance from the utility function. So let's do that. Get support and get resistance. Let me quickly import these two again. Alright, so now let us see what all information is required to get support and resistance for a given symbol. Get support, you have to give the list of lows, the current price, the range over which we can get the support price. The default is 20 pips, I'm fine with that. Pip value, we'll have to pass the pip. The default value is 0.0001, but for different symbols, pip can change, and we know how to calculate pip, so we can pass this value. And minimum occurrence is 2. So we want to have at least 2 occurrences of a given value in the range of 20 pips And if that happens, that would be counted as a support. So let me copy the whole thing here and let me paste it so that we have a reference of what to do. Alright, so let's do the easy stuff first. Let us get the pip values. So get pip MT5 symbol. So if I run this, you've got 0.0001. So we will pass that when our time comes. Then let me create the variable which we will return from this function, support resistance. It's going to be a list. The first value would be the support and the second value would be the resistance. Then we have to get the current price here as well. I've already imported get current price. So let's use that. So current price is equal to get current price. What all do we need to pass for current price? MT5 and symbol. MT5 and symbol. Let us quickly check what is the current price for Euro USD right now. It is 1.087, so that's fine. Now the only thing that we need to find is the list of lows or list of highs, and for that we need the historical data. And we can't use the historical data that we got for candle data because that was for a backtesting data frame. Here we'll have to do it for the support resistance time frame. So historical data is equal to, let me copy the whole thing here, get his data. Instead of backtesting time frame, we'll have support resistance time frame. And number of candles we'll have to change. We don't want to go so far back. Let us 200. Actually, you should not be hard coding values in a function. So let us make this as an argument. So let me call it bars. By default 200 or 100, whatever. Let's go with 100. Just change it based on your requirement. If you want to assess the support and resistance over a higher number of candles, you can do that. And here let me call it bars. And let me also make time frame as one of the argument. When we are calling find support resistance, we will pass support resistance time frame as the value for time frame. And here let me keep things simple and let me call it time frame. So now all that we'll have to do is append the support price and the resistance price. So let us first append the support price. So let me copy this, Control X, Control V. So get support, we need to pass the list of lows. So we'll do that in a bit. Current price we have already. A level range, no need to mention. We'll go with the default value of this function. Pip we are going to provide. And minimum occurrence also, we can go with the default value. So the only thing that we need to find is the list of lows. And if you recall, to get the list of lows, we need to get the hill valley column in our historical data DF. So for that, we'll have to call the get hills valleys function. So let's do that as well. Get hills and valleys, very nature friendly. And here, hist data hill valley is equal to get hills valleys hist data, right? So once we have got the historical data, do we want to actually see this once again so that we have a better understanding? Let's actually do that. So we already have MT5, we have symbol bars. Let me make this 100 and time frame. Let me paste support resistance time frame. Let me run this and see what we get. Oops, sorry, I'll have to mention num candles here. Otherwise, it will assume that I'm passing value for a different argument, right? So let us run this again and see if this works now. We've got the historical data. You can see that these are 4-hour data, 4-hour candles, because that is what we have assigned as the time frame for calculating support and resistance. Now let us run this. Actually, have I imported this? I don't think I have. So let me import get hills valleys as well. Now, if I run this and open historical data, you can see that we've got hills and valleys now, the highs and the lows. So what we have to do is take all these valleys, take the low prices for all these valleys and pass them to a list. And that would be the list of lows. So how do we do that? So hist data hill valley is equal to valley, and then select all the rows where this is true. So if I run this part of the code, you will see only the rows where we have this as value. Alright. Now I only want the low column. So dot low. So if I run this now, I will only get the low prices where hill valley column is valley. And then all I have to do is to convert them to list. So what this code will do now is that it will analyze all these low prices and then try to identify which is the most recent one that had a frequent occurrence, and it will identify that price as the support price. Okay, so this will take care of updating the support. Likewise, let me copy this and paste it for resistance as well. So get a resistance. I hope I'm spelling it correctly. It looks like I have. Hills valley is equal to, is it hill or hills? Let me quickly check it. It's hill. This would be high, right? High to list current price. So we'll get both the support and the resistance. And all that we'll have to do is return support and resistance. Just one thing I would want to mention here is that there may be a case where we'll not get any values here, or we might get insufficient number of values. So in that case, let's use exception handling and let us pass a default support and resistance value. So except if there is an issue calculating support or resistance, then simply assign support as the current price minus whatever number of pips that you want. Let's go with 80 pips. So 80 into pip, we already have calculated pip here. Likewise, for resistance as well, just take the current price and add 80 pips to it. So now this is our function of support and resistance. Let us quickly run this and see whether it gives us reasonable values or not. So find support resistance, symbol, support resistance, time frame. So if we run this, you're getting the value 1.0561 and 1.1017. Let's go back to our chart. Alright, so this is 4 hourly data. So it is telling us that the resistance price is 1.1017, which is close to here 1.10030. Yeah, so it is giving us the correct resistance. Now what about support price? Support looks very tricky in this case. We are only going back 100 candles. So, and yeah, so it looks like this value, if this is within 100 candles, might be this is the value, but let's check. 1.06561. So 1.06, actually it is giving us this value. Okay, so this is the 100 candles. So it looks like this is within 100 candles. So it is giving us one of these prices, 1.065. It looks like it is doing the job that it's expected to do. So now we have pretty much everything that we need. Let me quickly check where we are supposed to use find support resistance within our backtesting code. So it is supposed to be used here. And in which context we are using it? So think about it. So we will have to calculate support and resistance back in the time. So in this function where we have calculated support resistance, when we are getting the historical data, we are getting it for the recent time. So we're getting all the candles till the present time. This is not what we want. We want to have the flexibility wherein we can find support and resistance for historical values as well. So for that, we will have to make sure that within historical data, where is the historical data function? We are providing time till as well. So we'll have to include within this function, find support resistance, time till as well. So by default, let me make it none. But here we will have to provide time till. And here I'll have to have bars. Again, if you don't understand what I just did, think about it. Let's say we have got a signal here at this point of time. Then I need to find historical data such that the last row has this timestamp. I don't want to get data beyond this. Okay, so I only want data at this point of time, and MT5 allows us to do that if we assign the time till argument. So that's the change we have to make in find support resistance function. We have taken care of that. Now here in find support resistance, let us put everything that is required. Symbol, time frame and time till. So symbol is fine. Time frame would be support resistance time frame. And then the time till would be whatever is the index for that particular row which we are presently iterating. So it would be candle data dot index I. So this will give us the date, but this date would be in the date time format. We'll have to convert it into string, because if you look at the function that we have developed, the find historical data, it wants data in the string format. So string format time, we all know how to use this function, very important function in Python. Let us simply copy the same format that we have mentioned in the function. So I'm going to copy paste this here. So one more important thing that we have overlooked in the find support resistance function is that we have used the current price. So whatever is the current price when you're performing the backtesting, and that's not right. Think about it. For support resistance also, you're going back in past. So for example, if you want to calculate what would have been the support resistance at this point of time, you don't want this price, the current price. You want this price, because with respect to that price, you will calculate the support and resistance. So we'll also have to pass a current price here. So current price by default, let me make it none. So if we have none price, then calculate whatever is the current price. So let me make it. If current price is equal to none, then use the current price. Else, whatever is the current price, that is the price that we'll have to pass in the get support and get resistance functions. Alright. So here, what would be the current price? So the current price, we will use the opening price of the next row, because that is going to be our open price, and with respect to that price, we'll have to calculate the support and resistance. So you see what all things you have to keep in mind when you are implementing a backtesting code. There are a lot of things that can go wrong. So you have to ensure that each argument that you're passing to every function makes sense and is fit for purpose for the backtesting. Alright, so where else have I used find support resistance? Okay, just one more place. So let me copy this whole thing and paste it here as well. I think there's just one thing that I have overlooked, and that is that we cannot iterate till the last row. And that's because we have used I plus 1 in our code. So think about it. So the length of this candle data is 10,000. So the last value of I would be 9999. So if we are at the last row and I is 9999 and the code encounters this I plus 1, we'll get an error that the index is beyond the range. So we'll have to iterate through the index 9998. Alright. So that's the only thing that we had to keep in mind. Let us run the whole thing and let's see if I have overlooked anything, and then I can update the code on the fly. Right? So looks like the code ran alright. Let me open trade stats, and you can see that for this particular currency pair, we've got 34 trades. So let's take this trade for example. So this trade had a close price of 0.74123, open price of 0.75389. It was a long position, so we actually hit the stop loss. So we actually lost money here. Let's take another example. In this case, the open price was 0.60. It was a long position. The stop loss was 0.55. The take profit was 0.70318, and we actually ended up making a gain on this particular trade. So we've got an example of both profitable and a loss-making trade, and there were 34 trades during this backtesting period for this particular strategy. So now what we'll have to do is use this data structure and find the strategy performance. So in the next few lecture videos, we'll discuss the parameters on which we are going to measure this strategy. So we'll discuss things like win rate, mean return, drawdown, etc. And we'll see how the strategy actually performed. So over to the next lecture video. Thanks. Hello friends, before completing rest of the backtesting code, I would like to take a slight detour and talk about some of the key metrics that we use for backtesting any strategy. And we can call them anything. Usually they are called key performance indicators or KPIs. And these are some of the KPIs that are mostly used by intraday traders. And since the strategies that we will be implementing would be intraday, meaning the candles or the periods on which we would be trading would be less than a day. And therefore, I thought I would discuss some of these because we will have to implement them in our code so that we can measure these KPIs to assess our strategy. So the first and the most important KPI is the absolute return. Any strategy that is worth anything would have a positive absolute return. The higher, the better. And I don't think I have to explain what is absolute return. It is a total return that a trade or a strategy gives you from start to end. So let's say you started with $1,000 and at the end of the strategy, your balance is $1,100. That means the strategy return was 10% over that given period. And in Forex trading parlance, for absolute return, we use pips. So you can say that the strategy return 100 pips or 200 pips or whatever. Forex traders talk in terms of pips when they're talking about absolute return. So we'll also be using the same when we are implementing our absolute return function. Then the second KPI is the win rate. And this win rate is considered a very important KPI because that tells you what is the probability that a signal or a trade initiated by your strategy is going to be profitable. So ideally, we want the win rate to be more than 50%. The higher, the better. Having said that, a lot of intraday Forex traders do trade with strategies having win rate of less than 50%. Then you have to take other things into consideration, which we'll talk in a bit. But there is no hard and fast rule that a win rate has to be above certain threshold. However, the bigger, the better. And calculating win rate is very straightforward. You have to consider all the trades that were taken as part of a strategy. You have to calculate all the trades which are profitable and then divide it by the total number of trades. That's it. It's fairly simple to calculate. And if you recall, in the code that we implemented in the previous lecture video, we have got trade level information. So we have got the open price and the close price for every single trade that was executed as part of this strategy. And therefore, calculating win rate should not be that difficult for us at all. Then the next KPI is mean return per trade. And I consider this KPI as probably the most important KPI. And that is because this KPI tells us how impactful the signals of my strategy are. Again, calculating this is not difficult at all. We simply consider all the returns given by every single trade and then we calculate the average per trade. However, I have not seen anyone using mean return per trade. We use a slight iteration of this particular KPI, which is mean return per winning trade and mean return per losing trade. So what we do is that we segregate our trades by whether they were winning trades or losing trades, whether they had a positive return or a negative return. And then we calculate mean return for every single trade that was profitable. And likewise, we calculate the mean return for every single trade which was not profitable. And no prizes to guess, we want mean return per winning trade to be significantly higher than mean return per losing trade. Now, if you have a trading system which even has a lower win rate, so let's say you have a strategy that has a win rate of 30%, nothing really exciting. However, what if that strategy has a mean return per winning trade of 80% and mean return per losing trade of only minus 10%? So think about it. Out of 10 trades that your strategy is going to make, 3 of them are going to be profitable, 7 of them are going to be loss-making. However, the 3 profitable trades that the strategy would execute would return 80%, which is amazing. Whereas the 7 trades that are not going to be profitable are only going to cost me 10%. So overall, if you do the math, this would build a profitable trading system. So it's very important that you consider win rate along with these metrics, mean return per winning trade and mean return per losing trade. So next KPI is maximum consecutive gain or loss. This KPI simply tries to measure the largest winning or losing streak that a strategy had. I don't see a lot of value in this particular KPI, and that is why we are not going to implement it, because I don't really see what's the point of, just seeing whether a strategy had a streak or not. I mean, it may have value because if the losing streak was really high, then there is a possibility that a particular strategy would have wiped us out. But in general, we want to get the overall characteristics of a strategy. And in that scheme of things, maximum consecutive gain loss doesn't really fit the purpose. And lastly, a very important KPI is maximum drawdown. This tells you the largest drop over a given period of time. For example, in the following chart that you see, this is the progression of the return. This is the return chart. And you can see that this was the peak of the strategy and this was a trough of the strategy. So the difference between peak and trough gives us the maximum drawdown. And it is very important that you pay close attention to maximum drawdown because a high maximum drawdown has the potential to wipe you out. Because we are working with high leverages, we have seen that leverage compounds both positive and negative return. So if a strategy has high drawdown, taking leverage into consideration, a high drawdown has the potential to completely knock out our deposit. So we have to be very mindful of maximum drawdown of a given strategy. So in the next few lecture videos, we will implement some of these key intraday KPIs and then we'll try to measure the strategies that we have been backtesting using these specific KPIs. So I'll see you in the next lecture video. Thanks a lot. Hello friends. So continuing from where we left off, in the backtesting code that we have discussed so far, we have been able to get this variable called trade stats, which looks something like this. And this variable or this data structure is a list that stores every single trade that our strategy has generated. So our strategy would have generated 32 trades in the whatever backtesting period that we have chosen. And you can click on each of these trades and see what that trade actually would have entailed. In addition to this data structure, we also have the master data called candle data. And this candle data has every single candle that we have included in our backtesting. This data frame also has the technical indicators, the signals, etc. that we have generated. And if you had been paying attention, I had added another column called returns. I had initiated this column here. And then based on whatever signal we would have encountered in our backtesting code, I had been updating this particular column, returns. So returns was the last column. So anywhere in the code where you see for iLock, I have used -1 as the column identifier, you know that we are updating return. Alright, and you can see that in every logic code block, we have updated this return. If the backtesting code found that during a given candle, we would not have any trade, then we would simply update the return as 0. However, if there was a trade, then we calculate whatever return we would have generated during that candle. Okay, so I hope that you were able to follow along and you have a fairly good understanding of these two data structures, candle data and the trade stats data. So in this lecture video, what I'll do is that I will create some functions that will calculate the KPIs that we had talked about in the last lecture video. So firstly, absolute return. So for absolute return, I wouldn't really need to create any function because we have this candle data here and we have got this return column and you can see that, we have the pip return for each candle, 0, positive, negative, whatever. So all that we'll have to do is calculate the cumulative sum of this particular column and that will give us the absolute return. In the final lecture video of this backtesting code where I will be printing out all the KPIs, I'll just have a one-line code that will calculate the absolute return. However, for other KPIs, for example, win rate, mean return per winning trade, mean return per losing trade, and drawdown, we would definitely need to create some functions. So why don't I do that? So just like the utility and the technical indicator script, let me create a dedicated script and I'll call this KPI.py or, performance evaluation or something like that. And here we will create all those functions. So first of all, let me create a function called win rate. And what would be the argument to this particular function? Trade stats, alright? So we would have to pass this trade stats variable into this function and that would help us calculate the win rate. Now, we all know what is win rate. All that it tells us is that if my strategy had 33 trades, how many of them were profit-making trades? Let's take this for example. So the open price here was 0.712. It was a long trade and the close price was 0.7085. So this was actually a loss-making trade. Okay, so let's take the first trade. So the first trade of the strategy would have been profitable. You can see that the open price was 0.7944. The take profit price was 0.80656 and the close price was 0.80656. So this trade was a profitable trade. So all that we'll have to do is go element by element in this list, identify whether a trade was profitable or loss-making, and then simply take account. So it's very straightforward. All we'll have to do is just loop through our data structure and keep account. So let me create a variable called win count or profit count, whatever you want to call it, and then lose count is equal to 0. Now let us iterate through our trade stats. So for TS in trade stats, we'll go to every single element in this list, and each element is a dictionary. So we all know how to access dictionary very easily. So there are a couple of ways to figure it out. So if the close price is equal to take profit price, then we know that this was a profit making. And if that's the case, we can simply increment our win count. Likewise, if the close price is same as the stop loss price, we can increment our losing count. But I would not recommend doing that because in some trades, it is possible that you close out of the position without either meeting the stop loss price or the take profit price. If you recall, in our strategy, we have a condition that if MACD reverses, we also close out. So we'll have to find some other way to figure out whether it was profit or loss making. So our next way to do it is first to figure out whether this trade was a long position or a short position. If it was a long position and the close price was greater than the open price, then it was a profit making trade. If the trade was a short trade, then the opposite. So let's do it this way. It's a bit clunky way to do that, but it's easy to understand. So let me use this particular method. So if TS, the relevant key was direction DIR. If TS DIR is equal to long, then if TS close price is greater than TS open price, then increment win count by 1 plus is equal to 1. And if that's not the case, increment the lose count as 1. And let me copy this whole thing and do the same thing for short and paste it here so that we can update it for short. So if this is short, if close price is less than open price, we can have less than equal to as well. I leave that to you. But right now, let me keep it as less than. So if this is the case, we increment the win count, else we increment the losing count. So after this loop is over, we will have both win count and lose count. And then all that we'll have to do is return win count divided by win count plus lose count. Okay, and this should give us our win rate. So let me run this function and let me now test whether the win rate of our backtested strategy is good or bad. So if I run this, I'm getting a 30% win rate. Okay, not too bad. Could have been better, but 30%. Alright, so this was a very simple implementation of win rate. I'll stop this lecture video now, and in the next lecture video, we will create other KPI functions. So I'll see you in the next lecture video. Thanks. Hello friends. So in the last lecture video, we calculated the win rate for the strategy that we have been backtesting, and we got a win rate of 30%. So do we throw away the strategy? Not yet. As we discussed in the introduction of KPIs, even a moderate win rate could be profitable if other KPIs indicate that the strategy has potential. So mean return is a very important KPI because it tells you if you have a profitable trade, how much you make out of it. And if you have a loss-making trade, how much you lose in that. And if this ratio, mean return per winning trade and mean return per losing trade, is extremely favorable, say 3:1 or 4:1, then we have the ability to make even this low-looking win rate as a highly profitable strategy. So let us create these functions and let me call it mean return winner And again, because we are working with Forex, for return, I'm going to use pips. So the return value of this function would be pip. The mean return per winning trade is 20 pip, 30 pip, 60 pip, whatever. So we need to get the values in pips. So let me make it explicit in the name of this function. Once again, we would be passing the trade stats variable that we have already created. And then the structure of this function would be very similar to the win rate. We will again have to iterate through the trade stats list, identify the winning trades, and if it's a winning trade, then we calculate the pip return, and once we have all the pip returns, we can calculate the mean. So first of all, let me create a blank list called win return or something like that. So the idea is that for each winning trade, so in this example, there were around 35 total trades and 30% of them were successful. So this would have 10 return values. So the idea is that for each of those 10 winning trades, we would have the actual return in pips. Now it would be very similar to that. We first have to figure out whether it's a winning trade or not. So first we'll check the direction. If it is long, we'll check whether the close price is greater than open price or not. And if that's the case, we are going to append to this win return the return. And how will we calculate the pip return? Again, let me take you back to the trade stats variable. So the first trade was a winning trade. So in this case, the direction is long, so this condition would satisfy. Now, if the closing price is greater than the open price, so is that the case here? Of course, the closing price is greater than the open price. So what we'll do is that we'll try to see the pip return. So we'll have to subtract open price from close price. In this case, from 0.7944, we go to 0.8065. So that's around 120 pip return. So 56 pips would take me to 0.8000 and then 56 and 65. So yeah, around 120. So we'll have to subtract 0.794463 from 0.80656. So let's do that. TS close price minus TS open price. But this would give me a value in decimals. So this would give me a value like 0.0120. Do we want that? No. We want to get the values in pip. So to convert it into pip, we'll have to divide it by the actual pip value. So if I run this, we'll get 120. And that is what we want. We want to get the return values in pip. So what we'll have to do is that we'll have to divide this expression by the pip for this particular symbol that we are backtesting. So in that case, we'll have to call the getPip function that we have already defined in the utility functions. So why don't I import this function? So import getPip from utility functions, import getPip. And we also have to pass the MT5 object and the symbol. So within this function, let us also pass symbol and MT5. Here, I'll simply wrap this whole thing in a bracket and divide it by getPip MT5 symbol. And since we are already passing symbol and MT5 to this mother function, we should be fine running this. Alright, and now let me copy this code block and let me do it for short trades. So if TSDIR is equal to short, if close price is less than open price, then it is a profitable trade. And the return in case of short is open price minus close price. So this would be flipped. So open price minus close price. Once this loop is done, we will have 10 or 11 or whatever number of profitable trades that I had for my strategy. So all that I would need then is calculate the mean return. So we'll simply return. Let me give you some space so that you can see properly. So Python list data structure doesn't have a mean function, but we can very easily calculate the mean. We can use Python sum function and then pass the list. So this will calculate the sum of every single element within the list. And then we will divide it by the length of the list. And this would give me the mean of winning return. Alright, fairly straightforward. Let me copy this and let me paste this function so that we can calculate the mean return for losing trades as well. Only thing that we'll have to do here is flip the signs here. For long, if it is less than, and for short, if it is greater than. And just for the sake of completion, let us have less than equal to and greater than equal to, so that we don't leave out any trade. Alright, and that is about it. So let us quickly test these functions and see what we would have got. So symbol is, what is the symbol that we are using? AUD/USD, and then MT5 is fine. Okay, and before I run this code, I'll have to ensure that this current directory is pointing to where utility functions is stored, because we are importing utility functions. So let me do that. Alright, so within the backtesting folder, I have this, so it should work. So now if I run this, it should be able to import the utility function script. Alright, so that's taken care of. Now if I run this, it should work. So the mean return per winning trade is 332 pips. Not bad. What about mean return per losing trade? It is 137 pips. So almost 2.5:1. So I think in this case, we may end up having a positive absolute return. Again, we'll see in the final lecture video where we will create the equity curve and the absolute return. Ideally, I would have wanted this difference to be greater, say 3:1 or 4:1 ratio, but this is not that bad. Alright, and then finally, let us create the drawdown function. So define max drawdown, and for max drawdown, you will have to pass the actual candle data. And I'll tell you why. Because for max drawdown, we need to be mindful of every single closing price for the entire duration of the backtest, because we have to take that into account and see how the drawdowns have been happening over time so that we can calculate the maximum drawdown. So trade stats would not work in this case. For max drawdown, we will have to actually need the candle data. So let's implement this function. First of all, let me create a copy. I don't want to make any inadvertent changes to the candle data frame. And now I want to create a column called cumulative return. And I'm sure all of you know what is cumulative return. The whole idea is that now that we have return, we should be able to find the cumulative return, which is nothing but you just keep on adding every single return and then find the total return. Cumulative return is going to be df return. Is it return or returns? Let me double check. Oh, returns dot CumSum. So Pandas has a very nice and handy function called CumSum, which will calculate the sum of a given column cumulatively. Likewise, you have cumulative product as well. These are very handy functions, so make sure you're comfortable with these. So let me quickly show you how this thing will look. So now we have data frame, which is a copy. If I run only this part of the code, you can see that it is actually summing up every single return and giving us the cumulative return. So over the backtesting period, this strategy would have given us a 2685 pips returns, which is not bad. But again, this is not giving us the entire picture absolute return. We have to see if there was any periods where the cumulative return was highly negative, which could have actually impacted our equity and our ability to stay solvent and survive in the market. So for that, I will create another column called cumulative max. And for that, I would need the cumulative return column, and I'll use the cumulative max function of Pandas. So let me explain to you what it does. Let me first run this line of code. So right now, if you see, so this is my cumulative return. You can see that it goes up 338, 339, and then it starts going down. 400, then again from 400 it goes down to 371. So what cumulative max would do is that as it is going through this column, if it finds a maximum value, it will stay at that. So for example, at this point, 2.7 is the maximum value. So cumulative maximum at this point would be 2.7. Now if we go to the second row, the cumulative value would become minus 14 point something, right? But the cumulative max would remain 2.7. If we go to the third row, again, the total cumulative thing would be around what? Minus 41 or something. The cumulative max would remain 2.7. So as we are finding the cumulative sum, this 2.7 would change only if the cumulative sum exceeds the previous cumulative max. Alright, so that's all that we are trying to do. And I think you would have already guessed why we are doing that, because we calculate the drawdown, the max drawdown from the maximum point in a given strategy. So if I run this and show you the cumulative max, you will understand what I'm trying to do. Okay, so 2.7, 2.7, it stayed 2.7 for some time and then it became 13.7. And then you see how this is going. So all that I'm trying to do is I'm finding the maximum point or the peaks in my graph. And now drawdown is fairly simple to calculate. So DF cumulative max minus DF cumulative return. This would give me the drawdown. Again, this is not the max drawdown. This is simply the drawdown. So let me show you what this will do. So now if I open drawdown, so let's see how this would work. So at this point, 2.7 is the max value. From 2.7, it goes to minus 16.8. So the drawdown is 2.7 minus 16.8. That means you have lost 19.5 pips so far. Then again, if you go down, it further went down to minus 27.3. So our drawdown increased. Alright, so now we have got all the drawdowns. The max drawdown would simply be the max value of this drawdown array. All that I'll have to do is return DF drawdown max. So let us check what was the max drawdown for our strategy. So let me run this and see what we would have got. So max drawdown was also pretty huge, 1336 pips, which could have been very dangerous. We want this max drawdown value to be as low as possible. Alright, so these are all the KPIs that I would discuss. Like I had explained, there are a few other KPIs as well that people use. But if you have a good understanding of these 4 KPIs and you are able to use the values generated by these KPIs in the right context, you should be fine. Alright, so in the next lecture video, we'll be using these particular KPIs and close out our backtesting code that we initiated a few lecture videos back. So I'll see you in the next lecture video. Thanks a lot. Hello friends. So this should be a quick video. We have done all the legwork and now all that we'll have to do is complete the backtesting code that we started by evaluating our strategy performance using the KPI functions that we composed in the previous few lecture videos. Alright, so I have saved the code that we discussed in the last 2 lecture videos in a script called strategy evaluation. And what we'll do is that we would be calling those functions as well. So from strategy evaluation, import all of these. You can either do import this would mean import all the functions, but if you want to be specific and not have your IDE freak out at you, you can actually name the functions. Alright, so that's taken care of. Let us first generate the equity curve. Equity curve is nothing but the cumulative sum of your returns. And this equity curve gives us an overall understanding of how our strategy return would have evolved over time. And it's fairly straightforward to do that. So returns is stored here, candle data returns. We will calculate the cumulative sum of this and then we'll use pandas plot function. And that's pretty much it. So if I run this line of code, this is our return profile. So you can see that we would have started in 2018 with a 0 return. It would have gone up, but then to 2019, 2020 would have been challenging for us. But then mid-2020, our fortunes would have reversed and we would have seen an extended bull run. And which phase do you think is the max drawdown here? I think this dip here. So this is a pretty big drawdown. This could have blanked us. If you are working with a smaller equity, you would have lost your equity, right? So that is why maximum drawdown is actually very important. One of the most important KPIs that you should be mindful of and not just get swayed by the absolute return. Alright, and then also let's calculate the absolute return. Fairly straightforward. You already have the cumulative sum. All that we have to do is take the last value. So let us print out all the KPIs. The cumulative return in pips is equal to candle data. Let me copy this. Candle data returns comes from the last value. Alright. So if I run this, 2685.42. Now print the win rate of the strategy is equal to placeholder dot format. We have already imported the win rate function. Simply pass trade stats. Alright, so if I run this, we have already seen this, 0.30. You can round this to whatever decimal place, or if you like percentages, you can multiply it with 100 and then round it. I'll leave that to you. Now the average returns, average pip return per winning trade is equal to placeholder dot format. Okay, this is a long name, so let me copy the name of the function. Mean return winner pip. And then what are all the arguments? Trade stats. Let me quickly check it. Symbol and MT5. Symbol and MT5. We have already declared these variables. Symbol, we have it here. Symbol. And MT5, we have been initiating in all our codes anyways. So now if I run this, average pip return per winning trade is 330, 3 pips. Likewise, let me copy and paste it. And here per losing trade, mean return loser pip minus 137. And finally, the maximum drawdown in pips is equal to placeholder dot format candle data. Oops, what did I do? Sorry. Format function name max drawdown candle data 1336 pips. Alright, so now we have the entire backtesting code ready. If you want to test for any other currency pair, you can do that. So let's do it for USD JPY. You can change the backtesting time frame and support resistance time frame as well to tweak and see whether changing these is giving you a better result. So let me run it for USD JPY once. Okay, so for USD JPY, this would have been the equity curve. Again, I don't like this drawdown. It's pretty steep. From almost 3,000 pips, we would have gone to close to 500, so 2,500. Drawdown is not something that really thrills me. However, overall return would not have been bad. Win rate would have been 32.25%, and the mean return ratio looks favorable. Alright, so play with this backtesting code. See if you can make it better. Ideally, I would have wanted the win rate to be closer to 50%, and then these ratios to be even better. This would give us much more margin when we go live in the market, but that may require you to tweak a number of things with the input parameters, with the actual logic. So I leave that to you. The code is fairly flexible. All that you'll have to do is change a few things here and there and see how that is impacting the final KPI and the final performance. So I'll stop this lecture video now. So make sure that you have a very thorough understanding of how we implemented this backtesting strategy, what all constitute this strategy, because we are going to use the same strategy when we deploy it in the real market. Let me know if you have any questions and I'll be more than happy to help. Thanks a lot. Hello friends. Before we move on to backtesting a few other popular strategies, I just want to ensure that you have a fairly good understanding about the flow of this backtesting code, both flow and the structure, and that if you have to make a few tweaks here and there, you should be able to do with minimum additional code or minimal change to the code that we have already discussed. So for example, in the last few lecture videos, we backtested this code. We discovered that the performance of this particular strategy would have been lukewarm, nothing great, nothing very disappointing. So at this point, you may want to tweak the strategy a bit. So good place to start would be changing the backtesting and the support resistance time frame and see whether the strategy performs better on lower granularity candles or higher time frame candles. In addition, you may want to involve more than just one technical indicator. So in the case that we discussed, I only used MACD. You may want to include a few other technical indicators just to reinforce your signal and make sure that you reduce the number of false signals that you get. So adding technical indicators would be fairly straightforward. All that you'll have to do is just keep on importing whatever technical indicators you want. Just make sure you have the source code for that particular technical indicator in your technical indicator script so that you can very easily import it. And once you import it, let's say for example, we imported RSI. So all that you'll have to do is add a column for RSI here, and that should be it. And then wherever you are using RSI in the code logic block, you would have to do that accordingly. So I guess you would have to have an RSI index here as well, and then access that based on whatever logic you're trying to implement. Alright, so things like these should be fairly straightforward. I do not expect any one of you to struggle with making changes like adding technical indicators, changing time frames, etc. These are simple things. There was one issue with my strategy that I thought I should clarify, and that pertains to the support and resistance that we have used in our strategy. Many a times, traders don't use that kind of support and resistance. And there are several rules that traders use when working with various supports and resistance levels. So for example, let me take you to a sample price chart to give you a better understanding of what I'm trying to say. So for example, this is the AUD NZD 4-hour chart. And let's say we are here right now. So if I calculate the support and resistance at this level, it is possible that I will get the resistance level as this point, which is close to 1.08065. So right now we are at 7796, so close to 70 pips. So at this point, we will get the resistance as 70 pips. So that is the maximum upside that I have. If I get a long signal right now, that is the maximum upside I'm looking at. But what about the support level? So support level might be this or this. And if we go back, probably it would be this level, which is 6625. So this is almost a 150 pip support level. So you see the problem here? So if I get a long signal here, my strategy would set the take profit at 70 pips and stop loss at 150 pips. So almost 1:2 ratio. And a lot of Forex traders would balk at this kind of a prospect because the general rule among intraday Forex traders tend to be that your take profit should be 2 times your stop loss. Minimum 2 times, ideally 3:1, 4:1 based on which trader you're talking to. So in this case, it's the other way around. The ratio is 1:2. So the problem is that upside is very limited, but downside is fairly steep. So in our strategy, where we are assigning support and resistance as the stop loss price and the take profit price, we might have to reconsider that. And once again, you may come up with a totally different support and resistance algorithm, and that may change things here. Or you can go to find support resistance function here and make those relevant tweaks and ensure that the support resistance that you are returning from this function adheres to the ratio that you are looking for. Or if you want to do it in a less elegant way, you can actually do it here. So if you've got a long signal and then you have figured out what is going to be the open price, stop loss price, take profit price, etc. So once you have assigned these stop loss and take profit price, you can add another code block here to check what is the ratio between your stop loss and take profit. So let me copy this, if the take profit price minus open price, okay, so let me make this TP price. So this is one value that you need to consider, and likewise on the right hand side of the equation, we would have open price minus stop loss price. So this would be open price minus SL price. Now, if 2 times of this left-hand side value is greater than the right-hand side value, so just think about it what I did. All I'm doing is checking whether the take profit to stop loss ratio is at least 2:1 or not. And if that's not the case, I am going to set it. So this condition, if true, would tell you that you have an unfavorable take profit to stop loss ratio. So you need to manually reset the stop loss value. So trade stats minus 1 SL price is equal to, so now this would need a bit of algebra. So stop loss price would be the open price, whatever is your trade open price, minus half of the difference between the open price and the take profit price. Okay, so let me copy this whole thing. Again, it's not that difficult to understand what I'm doing here. All that I'm doing is that I am figuring out what is the difference between my take profit price and the trade open price, and I'm manually ensuring that my stop loss price is half of that. So for short, we'll have to do the same thing. So let me copy this code block and paste it here. So here it would be if 2 times stop loss price minus open price greater than open price minus take profit price. In that case, the stop loss price would be the open price minus this would get flipped when we are short. So open price minus take profit price. Alright, so this is the only change that you will have to make to this particular code. I am going to attach this code as well under the resource section for this lecture video. This was just to give you an example of how you can make minimum number of tweaks to the backtesting code format that we have been using to achieve most of the changes that you may want to make to your strategy. So let me know if you have any questions. Thanks a lot. Hello friends. An important criteria to consider when implementing your backtesting is the platform execution costs. The backtesting that we have implemented so far takes into consideration slippage, which is a very important factor when you are implementing backtesting. However, you may have noticed that I have not factored in the execution cost, and that is because different platform has different execution cost. So for example, these are the execution cost details for the Darwinix platform, which I would be using for actual deployment of my strategy. And what is the execution cost? So the Darwinix documentation says that for Forex, it is equal to 0.005% of the nominal value of the base currency. So for example, if you're trading one lot of Euro USD, so that means Euro would become the base currency, meaning you would buy 100,000 of Euro, the total round trip cost. So that means execution cost for both buying and closing out this position would be 5 euros. So in essence, this is equal to 0.5 pip. So if your strategy has a lot of trades, this execution cost can really add up. Alright, so how would I have included this in my backtesting code? Okay, so this is the MACD support resistance strategy backtesting code that we put together in the last lecture video. Where am I factoring in when we are closing out a position? I think it's here. So either if stop loss is triggered, or the signal is reversed, or if the take profit is triggered. So in all these scenarios where you are calculating the return, which is here, you would have to factor in the execution cost. So whenever we are closing out a position and when you are calculating the return, which is in pips, I would simply subtract this by 0.5. And this number would change based on which platform you are using. And that's the reason I have not included this in my code, but do include this when you are implementing your backtesting based on whichever Forex trading platform you are using. Alright, so likewise, we'll have to do the same every time we are closing out a trade and we are calculating the return. Alright, so that's something to be mindful of. And let me show you where you can find this execution cost or commission on the MT5 terminal. Alright, so this is a test strategy that I have running on Darwinix right now. So by default, if you go to history, you will only see the profit. You will not see any execution cost. But if you right click, go to columns, and then select commission, you will see a commission column. So you can see that for each trade, I am being charged close to 0.5 pip. And you can do the calculation, and this is exactly the commission that we are incurring. There is another cost that you might have to incur, and that is swap value. So if I click on swap, so let me show you an example of swap. So yeah, look at this. So swap is something that can either cost you money or get you some marginal benefit. And why are we incurring this cost? So this cost is incurred every time you hold your positions overnight. So what these FX platforms do is that they borrow currency from some other place in order to let you have that currency for trading. Don't forget, there's a lot of leverage that works here. So just like the Forex trading platform is giving you leverage, they are also borrowing this money from some other platform. And the interest rate differential is what is called swap. Again, I don't want to go into the math of this. And if you are interested, the Darwinix documentation explains what is swap rollover. But in essence, this is simply the interest rate differential between what the platforms charge you and what the banks charge the platform. Alright, so these are the two costs, commission and swap, that will impact your performance. I don't worry too much about swap or rollover, but I do worry about the execution commission. And especially if you have a strategy that gives a lot of signal, this is going to add up really quickly, and this can significantly alter your performance statistics. So make sure that you incorporate this based on the platform that you're using, and you improve your backtesting code based on the platform execution cost that are relevant to you. Thanks a lot. Hello friends. At the start of this section, I had promised you that I will discuss a few well-established and popular forex trading strategies, and that's precisely what I'm going to do in this lecture video. So this is the URL link that explains a strategy in a fairly good detail, and the strategy is called MACD and Stochastic Double Cross System. The whole idea about this strategy is that it takes both MACD and the stochastic technical indicator and incorporate them in a strategy. It is a very simple strategy to implement because all that you have to do is incorporate a few technical indicators, and even the exit is fairly straightforward, which we will discuss in a bit. So the first thing in this strategy, like many other strategies, is to detect a trend. Many technical indicator-based strategies rely on a trend to be pre-existing. And there are a number of ways by which you can determine whether the current asset is undergoing a trend or not. And I leave that to you which method you want to use. In this blog, they are using a very simple trend detection strategy, which is comparing the present price with a long-term moving average. And in this case, they have used a 200 period simple moving average. And we all know how to calculate simple moving average, one of the easiest things to do in quantitative finance. Alright, and once you detect that there is a trend, then there are some trading rules to follow. And this is the most important part of this web page or this blog, and that is what I'm going to explain. Alright, so they are saying that you can use this strategy for any instrument, be it equity, forex, commodity, whatever. The strategy is also period agnostic. You can use it for 1 hour candle, 1 day candle, 30 minutes candle, whatever. Although when I was trying to backtest, I saw that for very small periods, for example, 30 minute, 1 hour, the strategy was not performing that well. However, if you go to higher granularity periods, for example, 4 hour, 8 hour, 1 day, that is when it started to show some promise. So just be mindful of that. We will take a long position when first we have determined that there is a long-term trend that is existing for the current asset, and we do that by comparing the present close price with the 200-day simple moving average. Once that is taken care of, the second thing to check is whether the bullish MACD crossover has taken place or not. Now, what is bullish MACD crossover? We discussed this in the technical indicator section where I was explaining MACD. So bullish MACD cross occurs when the MACD line cuts the signal line from below, and the bearish crossover is opposite. When the MACD line cuts the signal line from the top, that is the bearish MACD cross. Once we have determined that there is a long-term trend, we check for the MACD crossover, but that's not all. We have to take this signal in conjunction with another signal, which is bullish stochastic cross. And we have also discussed stochastic technical indicators. The bullish stochastic cross happens when the K line crosses the D line from below, and the bearish crossover happens when the K line crosses the D line from top. And this is a very important requirement for this strategy, which is the stochastic crossover has to take place before MACD crossover. I mean before or in the same period. It cannot happen after the MACD crossover. This is very important. And this is going to be the most tricky part in implementing this strategy and this backtest. In this example, they want this stochastic cross to happen within 2 periods. So that is another thing we'll have to keep in mind. So for example, let's say in the current period, stochastic cross happens. Then you have maximum 2 periods after the current period wherein the MACD cross needs to happen. Alright. So if all these things happen, then we go long. Again, short is very similar. We first have to determine that there is a bearish trend, and that is done by comparing the closing price with the 200-day simple moving average. If it is less than that, then we say that it's a bearish trend. And then we've checked for the bearish stochastic cross, and that has to happen first. And within 2 periods of that, the bearish MACD cross should take place as well. So fairly simple trade entry rules, and the trade exit rules are also fairly straightforward. So we exit long when bearish MACD cross happens, and we exit short when bullish MACD cross happens. So if we are in a long trade, all that we have to do is look for a bearish MACD cross. If that happens, we exit the strategy. No take profit, no stop loss, very simple strategy. The only challenge that we are going to face is this part. But we'll discuss it in the next lecture video. It's not that difficult once you wrap your head around it. Okay, and one thing you may have figured out is that because it's a combination of a number of technical indicators, we are not going to get a lot of signals. You are lucky to get one signal a month with this strategy. But typically, if you implement it correctly, the win ratio is expected to be good. So that is the biggest allure of this strategy. But again, it's not a sure shot way of making money. Just like any other trading strategy, you have to be mindful of a number of things before implementing this strategy. Alright, so now let me take you to the MT5 terminal and show a sample signal so that you have a better understanding. Alright, so let me use a 4-hour AUD NZD chart as an example. So we already have MACD here. Let me also add stochastic. So insert, indicators, oscillators, stochastic. Stochastic, we are using 1433. Let me quickly verify that we are using the same parameters in our stochastic function. Okay, technical indicators, stochastic 1433. Great. So I'm going to say okay. And we have got our stochastic here as well. And let me convert this into candle because from the closing price, you cannot really make out which one is the exact candle. So that will help us identify. So we know that this is the candle. Alright, now let me take you to an actual signal. Okay, so this looks like a short signal that we would have got. So look at this. So 24th of July, 8 a.m. Okay, look at when I hover over these indicators, I get the date in the pop-out box. So just look at the time here, 24th July, 8 a.m. So on 24th of July, 8 a.m., you see the MACD, what happens? The red is the signal line. These bars are the MACD bars. Just try to imagine a line which is joining the top of all these bars, and that is the MACD line. Alright? So you see that the MACD line is on top of signal for some time, and at 8 a.m. on 24th of July, it actually cuts the signal line from top and it goes down. So this is a bearish MACD cross. So this is where bearish MACD crossover took place. So actually this happened here. Here it's still above. So here is the first time that MACD came below the signal line, which is 8 a.m. 24th of July. And now we have to see if the stochastic bearish crossover happened or not within 2 periods. Okay, so here it looks like it already happened. So let's go back 2 periods. So yeah, so within 2 periods, the stochastic bearish crossover also took place. The green line is the K line. The red line is the D line. So the K line cut the D line from top and it came down. So around here, I would have gone short and we would have exited when MACD bullish crossover would have taken place. Again, just visualize the line as the top of these bars. So this continued for some time. So somewhere, no, not even here. So somewhere around here, around this point. So this is where we would have exited. So at a price of around 1.0777 and we would have entered somewhere here. So 1.087. So a cool 100 pip profit. I'm trying to find a bullish crossover as well. Right now I'm unable to find it, but you should be able to find it as well. All that you have to do on the chart is look for first the MACD crossover, and then within 2 periods, the stochastic crossover should have also taken place. And wait a minute, I didn't add the SMA here. So that's also very important. So insert, indicators, trend, moving averages, simple moving average. So 200 periods. So let me also include that. So where did we get our signal? Again, let's go there. I think it was here, right? 24th July, 8 a.m. And you can see that the closing price was below the 200-day SMA. So this could be considered a downward trend at this point of time. Let me use the line chart to have a better understanding. Yeah, so if it's below, it's considered a bearish trend. Alright, so this was a basic intuitive understanding of the MACD and stochastic double cross strategy. Let us now try to use the existing backtesting template that we have prepared and try to make some tweaks in it so that we can generate the backtesting for this strategy. So I'll see you in the next lecture video. Thanks. Hello friends. So let us now try to implement the backtesting of the MACD stochastic double crossover strategy. And the code that we are going to use is the MACD support resistance backtesting code that we implemented earlier in this section of the course. Alright, so this is the code that we put together after a lot of effort. And now let us start capitalizing our effort, because the objective is that we should be able to use this template and make some tweaks here and there to create backtesting for pretty much any type of strategies, especially the ones that involve technical indicators. Alright, so let's get started. So the first thing is importing the functions. We are not going to require support and resistance, so let me remove every function that was required to calculate support and resistance. The exit strategy is fairly simple in this case, so we don't really need support and resistance. Get hills, valleys, I don't need any more. I think we need the others. For technical indicators, I would need the SMA, MACD, and also stochastic. Let me copy the name of the function, else we might get an error. So let me copy stochastic and paste it here. And let me import everything for strategy evaluation. So that's fine. What else needs to change here? I need the backtesting time frame. I don't need the support resistance time frame. So let me remove this. Because I don't require support and resistance, I don't need the time frame as well. Alright, so let me also remove the functions, because I don't like the distraction of these error symbols in my IDE. Wherever there is support resistance, I'm going to remove support resistance. So let me do that quickly. Okay, what is this? Unexpected indent. Okay, and stop loss price and TP price. Obviously, we'll get an error because we have just removed support and resistance. So let me move this thing here. And here also, let me move this thing here. We have taken care of removing the support and resistance related bits of this code. Okay, now let us start. The code flow is going to be the same. We'll choose a symbol, a backtesting time frame. Then based on that, we will get the candle data. And the candle data will have only open, high, low, and close. Then we'll get the MACD values as well. But along with MACD values, I also want SMA and the stochastic values. So let us get that as well. So candle data, SMA equal to, let's go to technical indicators and let's see what it returns. Does it return only the column or the whole data frame? It returns only the columns. It's very straightforward. And the default parameter is 200, so I'm fine with that. So it would be SMA candle data. That's pretty much it. Now what about the stochastic? So with stochastic, it returns both %K and %D. So let me copy this because this is what it's going to return. Let me paste it here and let me change this DF with candle data. So candle data %K %D is equal to stochastic candle data. That's pretty much it. So let me run the code till this point. Okay, so we've got the candle data. Let us quickly check what we have here. Okay, so we have the columns here, %K, %D, MACD signal histogram, SMA. We have everything that we need. Let me just scroll down to the end. Looks good. So just like before, we will initiate the signal variable with none. No problem with that. We are going to need the returns column as well. Trade stats is very important to calculate all the KPIs, so that stays. Now regarding the index, what all do we need? So MACD, open price, close price, high, low, we might need them. But in this case, because we also have SMA, so let us also use SMA index. Because we are going to need SMA, we are going to compare the closing price with the SMA price. So I would need SMA value as well. So let me quickly get the index for SMA. So we are going to need MACD, but we are also going to need the histogram index. That is because we have to check for crossover. So for crossover, the MACD has to cut the signal line from below or above. And if you recall, histogram is the difference between the MACD and the signal. So rather than using both MACD and signal, if we only use histogram, we should be fine because histogram will take into account both MACD and signal. So when we are saying that MACD is cutting signal from below, that means the histogram turning from negative to positive. Likewise, when we are saying that MACD cutting signal line from top, that means histogram turning from positive to negative. So I'm going to use the histogram index in this case. And here it would be histogram. And you will see once we go into the logic section, how useful this histogram is going to be. Now with stochastic, you would need the K and D index. So let us also get that. K index is equal to, let me copy this, paste it here. And let us see what is the column name again for %K and %D. %K, %D small. Okay. %K. Let me copy this, paste it below, and do it for D index. %D. I think that's about all the indices that I require. We will add or remove any index as we require it once we are implementing the code block. Alright, so what all need to change here? So we will change these numbers based on how far we are going from the present row. So we will update this in a bit. But let us see what major changes need to be done in the actual logic implementation. So if signal is equal to none, the first thing that we have to do is check whether the current price or the close price is greater than or less than the simple moving average. So let's do that. So if candle data ilog I close price index, so CP index, if that is greater than the SMA index, so let me copy this and paste it here. This would be the SMA index. If the close price is greater than the simple moving average, then that's the first condition met. Then the second condition is regarding the MACD crossover. So let's do that. So and candle data.ilog, let me get the histogram index. So think about it. We need to check for the crossover. So I histogram index is positive. All right. But that is not the full thing. You also have to ensure that the crossover has happened. So if current histogram is positive, you have to ensure that the previous histogram was negative. So you can check for I-1, but what I want to do is that rather than checking just the previous histogram, I want to check the previous 4 or 5 histogram, because think about it. When you are looking for an MACD crossover, you want a smooth crossover. You don't want a choppy crossover. So for example, if it is crossing over here, I would agree that this is the crossover because the previous few periods have been positive. You can either just check for 2 candles and figure out whether there will a crossover or not. I want to be a bit more conservative. So what I'm going to do is that I am going to check the previous 5 histograms and ensure that they were less than 0. Okay, so the current histogram is greater than 0. I want the previous 5 histograms to be less than 0. Again, we know how to do that. So I-5 till I histogram index is less than 0 all. Okay, so we have discussed this. Then we were implementing the MACD support resistance backtesting. I hope you understand what I just did. In this condition, I am checking the previous 5 candles to ensure that the histogram index for all those candles were negative. All. Okay, so if all the previous 5 candles histogram were negative and the current one is positive, then that's another condition satisfied. Okay, and the third condition is going to be the most challenging, and that is the stochastic crossover within 2 days. The bullish MACD crossover has happened less than 2 periods after bullish stochastic crossover. So it's not that simple. We'll have to create a function because if I implement it here, it will look really messy. So let me create a placeholder right now. So we'll call this function stochastic bullish crossover within, let's say, n periods. A long name, but I want it to be descriptive so that nobody gets confused. Okay, and I'll pass some arguments here. We will implement this function in a bit. Okay, so let me make it a bit smaller name. Stochastic bullish cross within n periods. This is intuitive enough. Okay, and let me create a function right now, a placeholder. We'll implement it later. So here, let me create the placeholder. So define the function. And right now, let me just use the pass statement here. So these are all the three conditions. If that happens, we get signal as long. We append the time, direction, open price, and close price. I'm not changing anything regarding the open price because that takes into consideration slippage, which I like. So let us leave it. Okay, I don't want all this stop loss, take profit adjustment. So let me remove all this. I love removing code bits from a code because it makes things clean, right? So that's taken care of. Let's do the same thing for short. It would be easier for me to just copy this code bit and paste it here and make the relevant changes. All right, so here it would be less than. Here it would be less than 0 again, and this would be greater than 0. I'll have to make another function called bearish crossover. So let me do that. Signal is short, and here it would be open index minus 0.3 time. This would be open index minus high index, low index. So open index minus the low index, right? And I don't have the bearish cross, so let me create this function as well. A placeholder, of course. We will update this function later. Define bearish cross pass. So we have taken care of when the signal is none. So we have now implemented the trade entry strategy. Now what about the trade exit strategy? Again, if it's long, I don't care about stop loss and all. So let me remove this code bit. If the MACD base signal reverses, yeah, I need the reversal. So let me keep that. So let me remove the first bit. I probably have to make some changes here. So I'll do that in a bit. Let me remove all the things that I don't need. Yeah, take profit and all, I don't care anymore. You don't have any take profit in this case. And this line we would need because this simply updates the return in case the exit doesn't happen. So that's fine. Now let's see what would have to be changed for the trade exit strategy. So if you recall from that blog, we exit a long position when there is an MACD bearish cross. So let us implement MACD bearish cross. So it would be pretty much this thing here. This is the bearish cross, so why don't I simply copy paste it? Alright, so if histogram is less than 0 and the previous 5 histograms were greater than 0, that means a bearish cross, signal becomes none, trade starts, close price. We'll use the next candle's open price. Again, I would appreciate if you can include slippage here, but I leave that to you. Consider this as a homework. Alright, and this is updating your return when we exit the trade. So nothing changes here. Now likewise for short, let me remove the stop loss portion. Likewise, let me remove the take profit portion, and all that we'll have to add here is MACD bullish crossover condition, which we have encoded here. Let me copy this and paste it here. Alright, no other changes. So that's pretty much it. That is going to be the basic structure of our backtesting code. And you can see that we have been able to implement the backtesting in around 100 lines of code, which is great because we have been using an existing template. So all that you need to be aware about the template is what code block does what, and you have to modify accordingly. Why am I getting this here? Get current price. I guess we don't use get current price. If I recall, the get current price was required for support and resistance only. So let me remove it. Okay, so I'll stop this lecture video now. All that we have to do is implement stochastic bullish cross within N periods and stochastic bearish cross within N periods. So let's do that in the next lecture video. Thanks a lot. Hello friends, so continuing from where we left off, let us now implement these two functions, which is arguably the most tricky part of this backtesting. We have never done anything like this before, which is figuring out whether a signal happened within N periods. And this is just an example of the kind of pitfalls you may receive when you come across a strategy. There may be certain challenging aspect of that strategy when you're trying to backtest it. This is just an example of how you can break down the problems and try to solve them. Again, this is not a one-shot solution of every kind of curveball that might get thrown your way when you're implementing backtesting. there are a number of fairly complicated strategies and you may have different challenges in different strategy. If you are able to develop a structured thought process of how you can break down the problems into smaller problems, solve them, and then combine the solution in your overall solution, I think my objective is achieved. Alright, so all that I did in this case is the logic that I found a bit difficult to implement, I kind of removed it from the overall code flow and created a function for it, and now I'll try to implement it. Alright, so in this function, all that we'll have to pass is the candle data and the current index, at which index you want to figure out whether the stochastic bullish crossover happened or not within n period. So for example, if I am using this candle data for my backtesting, I'm going row by row by row by row. Let's say I am in this row, okay, and I figure out that the MACD crossover happened at this row. Now all that I have to do is check for stochastic crossover here, here, and here. If that happens, I'll return true. If that doesn't happen, I'll return false. Alright, so it's very important that I pass this entire candle data, this index that I'm working with, and also the number of rows you want to check up or down. Alright, so let us pass those parameters here. So current index, and let's use n periods. By default, I'm using 2 because that is what this strategy requires. But if you want a different n, you can supply it. And because I need to figure out stochastic crossover, I would require the K and D index because I would be looking up the K and D values. So why don't I regenerate these values here? This candle data already has %K and %D column. All I want to know is the index because I'm going to use them. Alright, now let's start. We have a data frame and we know the row. So what we'll have to do is loop through that row and the other rows that you want to check where the crossover happened or not. So we will have to use some kind of a loop here. So let's do that. So for I in range, we want to go from current index to 2 rows back. So current index minus n. Again, -1, we'll have to do -1 because that is how it works in Python. So the range function goes from the starting point till the end point, not including the end point. So you have to put in -1 here. Actually, let me show you what I'm trying to do here. So in this case, I want to use the range function to count backwards. I in range, let's say I want to go from 10, 9, 8. So if I do 8 here, it will not work. Print I. Again, these are basic Python concepts, but I want to ensure that all of us have a good understanding. So 10, 9, right? It doesn't include 8. If I do 7, it would be 10, 9, 8. Alright, so I have to put a -1 here. Okay, and we all know if you put -1 as the increment argument to range, then it increments by -1 and not +1. Alright, so this will ensure that we go back 2 candles. And now we'll do whatever we want to do. So we have to check for the crossover. If candle data dot ilock, row is I and the column is the K index because the K needs to be more than the D index. It has to cross the D index from below. So for the current row, the K index needs to be greater than the D index. So let me copy this and paste it here. And we have to ensure that the previous few K indices were less than D indices. And let's use the same count that we are using for MACD. We'll check the previous 5 candles and make sure that the D index was greater than the K index during those 5 candles. So candle data dot ilock. Again, we have to be a bit careful here. We want to check from index I -5 till I, not including I, because we are already including I, so I can have I here. And then this would be K index. We are going to subtract these 5 values, the K index values, with the corresponding D index values. And we have to ensure that all of these were negative. Okay? Dot all. So that will take care of my bullish crossover. So if that's happened, we can return true. Let's say we are iterating. If this condition gets satisfied in the first iteration only, the function will return true and stop. Let's say it doesn't happen. Then the iteration would continue. Then it will go one row above. It will perform the same testing. Then if it returns true, very well, the function will return true, and then we'll exit out of this function. But if the full iteration is completed and still this condition is not satisfied, by default, we will return false. So if you break out of this for loop and still you are unable to fulfill this criteria, we will return false by default. So actually let me test this function to see whether this works or not. So let me check every single candle in our candle data and see where we are getting this. So for I in range, actually we were supposed to change this as well in the previous lecture video. So let's do it right now. So what would be this value? What is the maximum we are going back? So 5. So this would be 5. And what is the maximum we are going forward? I think it's I plus 1. We are using that for slippage. So this would be -1. Alright. So this would be the same. So why don't I simply copy this? So let us iterate through all the available rows in the data frame and use this function. If this happens, print candle data dot iloc I. Let us see which rows this thing gets satisfied. So this would be I, and I don't need n is equal to 2. That's pretty much it. So let me run these lines of code and let me see what happens. Okay, so you can see that the code is running. We are getting the candles where this function would have returned true. So let's take one for example. It is saying 15 December 2023. So let's see what happened on 15 December 2023. So 15 December 2023, 4 p.m. Alright. So let's see. The stochastic crossover should have happened within 2 periods of this. So let's check for stochastic. So here %k is actually less than %d, so not good. But if we go 2 period back, I think this is what it is referring to. %k is greater than %d here, but for the previous 5 candles, %k was actually lower than %d. So this is where the stochastic crossover took place. But because we want our function to return, even if that stochastic crossover happened within 2 periods, it is returning true for this particular row. So by definition, I think the previous 2 rows should also return. So let's confirm it. So 15 December 2023, 4 p.m., right? Likewise, 15 December 2023, noon is also a positive signal. And this is the actual candle where the crossover took place. So obviously, we will get this as well. So the function is doing what it is expected to do. So that is a great thing. Let me remove it. Now let me copy this whole thing, paste it for bearish crossover. Let me first give the arguments and let us change the crossover logic. This would be less than and this would be greater than. That's pretty much it. Alright, so I think this would take care of our code. Let me run the entire thing and let's see how would this trade have performed over the given backtesting period. Okay, so we've got an error. Obviously, I didn't update the function here. Sorry about that. So here I'll have to pass candle data and I. Likewise, I'll have to pass candle data and I here. Okay, now let me rerun the code. Alright, so let us look at the plot. So this didn't really perform very well. We can see that the win rate is actually good. Win rate is close to 60%. But the winning to losing ratio is actually not good, not favorable. And that's expected because we are not taking control of our exit strategy. We are letting the technical indicators decide it. So that might be one of the reasons why this has happened. Again, something for you to work. This is a starting point. You may have to slice and dice this code, improve your entry or exit strategy to actually make this thing work. Let us do it for one more currency pair. Let's do it for USD CHF. Okay, so for USD CHF, it actually turned out to be not too bad. Again, win rate is 54%. So win rate would be close to 60%. That's what I've seen. It ranges from 55 to 75%. But in this case, you can see that our average return, winning and losing is comparable. So in this case, we ended up having an okay-ish kind of an absolute return. But there is one more problem with this strategy. Look at the backtesting period. It's almost 6 years. Now let us look at the number of trades that it gives you. 37. Okay. So on average, you are getting 6 trades per year. So in 2 months, you've got 1 trade. So that's another problem with this particular strategy. Because it needs a number of things to happen in confluence, the frequency of trades is going to be less. And as we have discussed, there are a number of things that we may have to improve upon. The win rate is decent, no doubt about that. But this is a bit problematic and you should devise a better strategy to ensure that this ratio is favorable. Alright, so I'll stop this lecture video right now. You have enough food for thought to take this code and improve it. So go ahead, play with the code and let me know if you have any questions. Thanks a lot. Hello friends, I want to include one more strategy in this section, and that strategy is called the triple RSI trading strategy. And I'm including this strategy because we spent time implementing the RSI technical indicator earlier in this course, and I wanted to include a strategy that incorporates RSI as well. So this is a URL that gives a fairly good understanding about what this triple RSI trading strategy is. Let me tell you at the outset that this strategy is more popular among ETF and other equity asset traders. However, a lot of forex traders use some iteration of this strategy as well. RSI is a widely used technical indicator, and I want to include at least one strategy that incorporates RSI. Alright, so having said that, the strategy is fairly straightforward. All that it uses is the 5-day RSI indicator, and the rules are fairly straightforward. The first thing is that just like double crossover strategy, the close price needs to be higher than 200-day moving average, whether the asset is currently under a bullish trend or a bearish trend, so that's very important. Then all that we need to do is consider the 5-day RSIs for 3 successive candles. The current RSI should be below 30, and this current RSI should be lower than the previous RSI, and the previous RSI should be lower than the previous RSI, and likewise, the second last RSI needs to be lower than the third last RSI. So in a sense, what you have to do is that you have to ensure that the RSI values has been declining for 4 periods, and that the fourth last RSI was also below 60. Okay, and once we will implement this in Python, you will see that this is quite simple. Even simpler compared to the double crossover strategy, because all you have to do is take care of one technical indicator. I mean, there is also the second SMA technical indicator, but that's very simple as we have seen it in other strategies. Alright, so this is the trade entry criteria. Now what about trade exit criteria? Again, very simple. Once we are long, we exit when the RSI crosses 50. Alright, so the entry criteria is when it comes down to 30. We exit when it goes up to 50. So let me show this to you on a chart so that you have a better intuitive understanding of this strategy. Alright, so I have a USD CAD 4-hour candle chart in front of me. Now let me insert RSI. So you will get RSI in oscillators, relative strength index. So the block said that we want 5-period RSI, so I am going with 5 period. So this is where a signal would occur. Just look at this candle. 28th of March, 8 p.m. So what is the RSI here? 26.95. Is this less than 30? Yes, it is. And were there 4 successive decline in RSI? So this value than 30.81, that's fine. So there was a decline. Then there was a decline 2 days ago as well, 3 days ago as well, and 4 days ago as well. And this 4-period prior RSI was actually 50.76, which is lower than 60. Oh, once again, I forgot SMA. So let me also get the SMA. So moving average, simple moving average, 200 period. Okay. Alright. So the close price is way above the SMA. So we are fine. Alright. So we would have got in at this point, right? So this was our trade entry point. And when we would have exited, so the exit is when it goes above 50. So I think it was somewhere here. Yeah. So here it goes above 50. So we would have exited here. So from here to here. So it's a small profit, but you will see that this strategy has a high win rate, but the per trade returns are relatively low, both for winning and for losing. So that's something to be mindful of. And we'll see that once we implement it in a bit. Again, this is just one version of triple RSI strategy. There are other versions of triple RSI strategies as well. In other strategies, people use RSI of different periods. So 5 period, 9 period, 15 period, and use those into consideration. However, I wanted to do something simple for this lecture video so that you have an intuitive understanding, and I would expect you to take the code that we'll put together in the next lecture video and then play with it, use different iterations of RSI, tweak it, and see if that strategy works for you. Alright, so in the next lecture video, we will implement the triple RSI strategy that we just talked about. See you in a bit. Hello friends, so let us start implementing the triple RSI strategy, and we'll be using the double crossover backtest code that we put together a few lecture videos back as our starting code. Alright, so first of all, what all technical indicators I need? I need the SMA, I don't need MACD, I need RSI, which is already implemented in our technical indicators, RSI. And by default, n is equal to 5, so I don't need to worry about providing value of n as the argument, so that's a good thing. Nothing else needs to change here as of now. We'll revisit this import section based on how our code is progressing. Alright, symbol, let me do it for USD CAD because I just showed you the USD CAD chart. Backtesting time frame, let's start with 4 hourly time frame. But let me give you a heads up is that I have tested this strategy, and usually it works better with lower time frames, like 30 minutes, even 15 minutes sometimes. But right now, just for the sake of consistency, because we have been backtesting other strategies on 4-hour candle, I'm using 4-hour candle. Feel free to change it. Alright, and then I don't need MACD and all that, so let me remove this. All I need is RSI, and I can get that by calling the RSI function, candle data. Alright, so let me run the code till this point. We've got the candle data. Let's see how it looks. It has around 3000 rows, and it has the SMA and the RSI columns. So now all that we'll have to do is go row by row and then look for our trade entry and trade exit criterias. I don't need all these anymore, so let me remove this. Alright, here what all do we need? So signal is fine, candle data, let's have the returns column, no problem with that. Trade stats, we're going to need that. SMA index we'll need. I don't need all these MACD and stochastic related indices. All that I need is the RSI index. That's pretty much it. Let me copy this and paste it here. And instead of SMA, this would be RSI because that is the name of our column. Now within the loop, I'll have to revisit this initial value for the range argument. And we know how to do that. That will depend on what is the maximum farther I'm going from the current I or current row. But we'll come to that in a bit. So the first criteria was that our closing price should be greater than the SMA. So that's fine. Nothing needs to change yet. Then we'll have to implement the RSI specific criteria, which is the current RSI index needs to be less than 30. Then the current RSI index needs to be less than the previous RSI index. Alright, so I minus 1. And we'll have to do the same thing for 2 more previous RSIs. So let me copy and paste this here. So I minus 1 is less than I minus 2. And lastly, I minus 2 is less than I minus 3. And is that all? No. We have another criteria that the fourth last candle should be less than 60. So I minus 3 RSI index is less than 60. So that is our trade entry criteria. Let me double check if everything is fine. I have not made any typo or logical error. Looks like this is it. Alright, so if this happens, signal is long, we will update the time, direction, the open price, and close price will be initiated as none. Nothing needs to change here. Although the blog that we referred to didn't mention anything about the short signal, I'm anyway going to incorporate that in this backtesting template. If you want, you can comment this out. But just for the sake of consistency and completeness, I'm going to include both long and short signal using similar logic. Alright, so let me copy this whole thing, paste it here. Let me make this elif. So if the closing price index is less than the SMA, if the current RSI is greater than 30, this is greater, and this is greater than 60. I mean, you can make this 40, 70 if you want. Although we don't have clarity whether this strategy even works for generating short signal, we are simply using the same intuition and seeing whether it works for short signal or not. Alright, nothing needs to change here. Now, what do we need to do if the signal is long? Again, exit criteria is fairly straightforward. All that we have to do is check whether the current RSI is greater than 50. So let us do that. Okay, so check if the RSI base signal reversed. So if that happens, we close out, we update the close price, and we update the return. Likewise for short, let me update this. Oops, I didn't give the actual logic here. So if this is greater than 50, actually let me make this a 60 and make it a bit more aggressive. Likewise for short, let me make this less than 60. Alright, so for long, we exit if the RSI goes from below 30 to above 60. For short, we exit when the RSI goes from above, okay, I have screwed up, sorry. This should be 60 and this should be 30. So for short, we want to make sure that the RSI goes from above 60 to below 30, okay? Let's make sure that our logic is consistent. Nothing else needs to change here. So I think this should be it. This should be the code. Let us quickly run this and see what we get. Let us run the whole code. Alright, so you can see that we have got a cumulative return of minus 330. Plot is like this. It doesn't look very good. Let me try to do something. Let me remove the short part of this code. So in Spider, the shortcut to comment out a code block is Control-1. So let me do that both for short entry and short exit. Let me remove that. And now let me run the whole code again and see if this gets any better. Okay, so it does get a bit better. We've got a cumulative return of 423 pips. The win rate is actually 65%. But a troubling part is that average return per losing trade is actually more than the average return per winning trade. So this is something I'm not very excited about. But another good thing is that the drawdown is also not huge. So that is expected. We exit based on the RSI, and it's very unlikely that the RSI would remain at a very inflated level or a very deflated level for an extended period of time. So drawdown in this strategy should not be very scary. Okay, let us see how many trades we got. So let's go to trade stats. So we've got 26 trades over a period of, so from April till end of the year, so 9 months. So in 9 months, you've got 26 trades, so around 3 trades a month. Let us see a few trades, for example. So here we got a long signal. We entered at 1.275. We exited at 1.281. So a nice 66 pips return. Likewise, you can check for others. I mean, win rate is always going to be good for this strategy if you only use it for long signals. But if you want to make some tweaks and make the short also work, that would be great. Alright, let us do it for one more currency. Let us do it for AUDNZD. Let us run this and see how we get it. Okay, once again, win rate of around 60%. The absolute return is not that good, 248 pips. And let's look at the plot. Yeah, this could be better. Alright, so I hope you got a good understanding of the strategy. Play with it, tweak the parameters. If you want, feel free to change the exit criteria, use some other technical indicators to exit, get a bit creative, and see if you can improve the performance of this particular strategy. So I'll stop this lecture video now. Let me know if you have any questions. Thanks a lot. Hello friends. Finally, an assignment to complete this very important section of this course. So far, you may have noticed that in every backtesting strategy that we have implemented, I have been doing it for only one symbol. However, as you may appreciate, this is not a very practical way of backtesting. We rarely trade on only one currency. Typically, traders have a basket of currency that they trade on. So what I want you to do is that I want you to expand this code such that we can include a number of currencies within the symbol variable. So for example, in this case, I repeated the first symbol. So AUD, NZD, Euro, USD. And if you want, you can have as many currencies as you want. So I want you to enhance this code such that we can perform the backtesting for a number of currencies concurrently. And let me give you a hint of how to go about it. It is essentially a Python data structure problem. So here we have been saving everything in lists and data frames. You will now have to use some other kind of data structure, for example, dictionary, to hold data for each symbol. Alright, so for example, we had been storing the historical data in a data frame called candle data. So now this candle data will look something like this. So candle data would look something like, the currency, USD CAD, and then whatever is the data frame. Alright, likewise. So you'll have to make one change here. Likewise, you will have to make a similar change for trade stats. So for each symbol, you would have to store all the trades that took place and their respective information. And one other important thing that you will have to change is these KPI functions. So if you have been paying attention, all these KPIs is for individual data structure. So for example, right now this trade stats is only for one ticker. However, now our trade stats is going to have information for a number of symbols. Okay, so you would have to make some adjustment to these KPIs as well. Alright, so I've given you enough hint to expand this code and make it accommodate a number of symbols. Give it an honest try. I'm kind of debating whether I should upload the solution or not. I might upload it, but that may be sometime in the future. Right now, I want students to make a genuine attempt and expand this code to achieve this enhancement. Alright, so let me know if you have any questions pertaining to backtesting. It is one of the most important parts of this course. So make sure you have a very thorough understanding of how we backtest. Thanks a lot.